Good morning, everyone. It's a beautiful day in the neighborhood, a beautiful day in the neighborhood. Will you be mine? Will you be mine? For those of you that grew up on Mr. Rogers, boys and girls, the word for the day is sell. Can you say that? Sell. I know on Wall Street it's a four-letter word, but that's the kind of mood I'm in right now. At any rate, we have a very special guest on today. Probably most of you have never heard of him. My good friend Albert, I'll let him talk a little bit about himself, his last name or whatever. Albert is truly a global citizen globally of the investment world. He is a French citizen living in Israel. I've known Albert actually going back to the late 80s or early 90s. I think it was the 80s actually. He's very quantitatively driven. We all have opinions. He has his as well. But what I love about Albert, he's a great macro thinker. And I think one really needs to pay special attention to his message. As the saying goes, liars figure, but figures don't lie. And the financial pornography he's going to share with you today is just mind-boggling. I will be posting these slides up momentarily. A few things about where we are. This week was kind of monumental. If you look at my Twitter feed, you'll see in the last few days, I put up a feed, I think it was yesterday, where I was referring to the so-called triple demerit scenario. And maybe, Albert, in your remarks, you could go back to the good old days in Japan, where we had the triple merit scenario, where you had falling interest rates, I think it was a falling dollar, and falling oil prices, provided a very favorable backdrop for Japanese corporations. And that was the backbone for the liquidity-driven market we saw in Japan, which catapulted Japanese banks to 100 times earnings and 10 times book value. That was truly one for the ages. And not to scare all the women and children in the room, but we have a similar development now in the United States and in markets globally. History doesn't repeat itself, it rhymes. And yes, it's interesting to think about how this is different from Japan. And usually if I invoke Japan, people go nuts. But the whole idea about this liquidity-driven market that's blown valuations to the moon, that's the key point, really. And Albert will speak to that. So anyway, coming back to my Twitter rant from this week, I pointed out how, despite concerns of a slowdown, everyone's become an armchair yield curve expert now. First they had their career in being an armchair epidemiologist. More recently, they've all become foreign relations experts. Now they're on to yield curve. And yield curve to me is all this chatter about the yield curve. People don't know what the hell they're talking about, and we can get into that later. But at any rate, despite the flattening yield curve, fears of a slowdown, fears of what might happen in the Ukraine, you've seen interest rates march relentlessly upwards, the 10-year clearing 280 this past week. And I believe rates are going much higher. I've spoken about that before. I'm happy to talk about that later in the show. Oil prices, we had the predictable tape bomb risk from the SPR release. That's now behind us. What's Biden going to do now? Release another 180 million barrels? Don't think so. The market's called us bluff and they're seeing right through it. And, if you think we're going to get a recession, okay, fine, oil prices will go down. But my own belief is no. I think we'll get a slowdown. I don't know, we'll get a recession. That's not my central case right now. That can change. But the real story behind the oil price is not the events in the Ukraine. Oil's been going up for, a year and a half, 2 years. It's got nothing to do with Ukraine. It has all to do with the lack of a supply response, and that dynamic has not changed. So you had the dollar going up, you've had oil prices going up. Sorry, you've had interest rates going up, oil prices going up, and you've had the dollar strengthening. The dollar is, as the often overused phrase goes, the cleanest shirt in a dirty laundry pile or whatever. And so that constellation rising oil prices, rising interest rates, a rising dollar. That is unambiguously negative for risk assets and U.S. equities. If you feel otherwise, bring it, because the facts speak for themselves. So I think again, the equity market continues to offer return-free risk, very limited upside, huge downside. On top of it, the force is now with you. The Fed wants the market to go down. They want to tighten financial conditions. Part of that is getting equity prices lower. And so rather than people, in the years past pointing to the idea of a Fed put, I think it's completely the opposite now. It's a Fed call. So you've got a Fed call. They always say don't fight the Fed. Yeah, well, the Fed wants the market to go down. Like, what is it you don't understand about this? Stay with the trend. You have a series of lower highs and lower lows. Michael Howell has been in this room numerous times. We've tweeted at quite a bit. The liquidity conditions, the tide's going out. My Australian K is receding. I hope Shrub will talk later. He always keeps putting out the monthly flows. If I'm not mistaken, the flow data was actually negative for the first time in a while this past week. So I think, unless something changes right here, right now, I think the table is set for a pretty big decline in the equity market. I'm not saying it's today or tomorrow. And yeah, someone will come on, the market will probably go up this week, and someone will come next and say, see, George, you were bearish, and it went up. Dude, I've been calling out Cathie Wood in the ARC trade, long energy short Cathie Wood, for almost a year now. That trade's up 200%. So don't come to me with your week-to-week daily nonsense. We're here to make money. We're here to invest. We're not here to speculate. All right, enough of that. I'd like to introduce Albert. Albert, I don't have the slides up. As you start talking, I will put the slides up. Albert is he invests globally. He's worked in London, worked in the States, worked in France, worked in Israel. He understands global markets, and he's very quantitatively oriented. So what I really like about Albert is the way he puts together the macro with the quantitative, and he also has individual ideas. And yeah, he can put a narrative with the ideas, which he does. But as opposed to yours truly, where it's I have an opinion and I search for the quantitative justification. That's a little bit tongue in cheek. Albert's views are really rooted in fundamentals, and so here he comes. It's funny. I got two different people up here. I'm not quite sure who is who. Hey, Mr. Billy Bucks, is that you?
Yeah, that's me.
Yeah, Mr. Billy Bucks. Who's the guy next to you? Dan Allen. Is that you as well?
No, that's not me. Actually, that's a friend of mine. I don't know. He's not allowed to speak. Well, he's not allowed to speak.
I know. I don't want him to speak. In fact, when I first saw it, I got confused because it says French citizen, U.S. born. And then I looked at the picture. I'm like, that guy's much better looking than you. So it can't be you. So
I was going to say the other way around. I'm much better looking than he is. And he's fatter as well. And he can't speak. He can't speak, so I can say whatever I want.
Oh, you know what? To make you. Do you want me to put him back in the audience so he can't speak? All right. Hey, he will behave, because if he opens his mouth and takes shots at you, I'll throw him back in the audience. We'll leave him up here for now. So Albert, did you hear my whole introduction, or because I only just saw you show up now? Did you hear my whole introduction?
I did. Thanks a lot.
Yeah. Okay. Great. So the floor is yours. I will start putting the slides up, and they'll be up shortly. So the floor is yours. Why don't you just tell folks about what you do? And I didn't really mention Albert he's a great investor. He runs a research service as well. And so if you're interested in his remarks, he can be reached via email or Twitter. So Albert, maybe the floor is yours. Talk about who you are, what you do, and get into your views. And as you're speaking, I will put up the slides. The floor is yours, Albert.
Okay, great. Thank you. Thanks a lot for the intro and let me speak on this great forum. Actually, so we met. You and I met at the end of the 80s, just as the Japanese market was was going crazy, and just a few remarks on that. But the main thing is in Japan, if you were 6 months early shorting this market, you were dead. And I guess that was that was a very good training trying to short these Japanese stocks. Very good training for the, let's say, the bubble of 2000, and there as well. I guess if you were a little bit early, you could be dead as well. The interesting thing is, we've been, you and I, we've been through, Japan and and all the other bubbles. What this one feels a bit different, I feel, because it feels like being a little bit early. First of all, it feels like being a little bit early is not as painful as being early in 2000 and being early in Japan. And also this one, there's a saying, nobody's going to ring the bell at the top. But on this one, it looks like the bell has been rung, and it's been rung, fairly loudly. And I guess the reason, I still try to understand how come the market is not, is not going down much further. One of the reasons being that, you don't kill a bull market, a 40-year bull market in 1 day or in 1 week or in 1 month. There's a huge amount of people that believe that this market is going to go on forever, and therefore it's got a lot of staying power. But as you mentioned before, the factors, the negative factors are so much out in the open that it's I think it's very, very difficult here to be to be wrong on what's next. In fact, I don't see any scenario where the market could be, certainly could be making new highs, and certainly in terms of valuation. On this intro, so just going back to what I do or what I've been doing, I've been in financial markets since 1984, which is kind of scary. I've been running hedge funds from the late early 90s until 2006. And then I sold my hedge fund group to ABN AMRO Bank, and since then, after a long break, I've been running a research advisory firm, mainly advising some of the largest hedge funds in the US and in the UK, and some in Asia and Brazil, and as well some high net worth family offices in Geneva. And the the main thing I'm doing is actually, we've got a huge database screening thousands of companies. As George said, I have a quant approach, and I basically get my macro ideas from bottom up analysis of valuation dislocations and stuff like that. And we're looking through valuation dislocations in terms of markets between each others, in terms of sectors, and in terms of companies. And that's been very very helpful throughout the years. I must say that getting older, I allow myself even to have top-down ideas, more often than not, actually, and which I try to confirm with my quant analysis. But yeah, I spent most of the time actually looking at individual stock situations. But again, having been in the market for such a long time, you can't escape having your own views and putting them to work. So anyway, so that's the intro. So George, where do you want me to go?
So Albert, maybe just start speaking to the graphs that you have, and starting off with the first one where you have inflation causes PE dilution. So I'm putting them in the order that you gave them to me, Albert. So go ahead.
Okay. All right. Okay. So this this first chart on George's feed, is showing basically the earnings yield, which is the inverse of the price earnings ratio, with the CPI, and that chart goes back to 1995. And I guess if you are going further, you would see probably the same correlation. But basically, the earnings yield, or the inverse of the P, is moving step in step with the inflation rate, with the CPI, and basically when inflation goes up, the earnings yield goes up, meaning the P goes down, and vice versa. And so, what we see in 2021 and so far this year is that the CPI has exploded upwards, and the earnings yield still needs to reflect that. And so what seems to be certain is that the increase in inflation as to cause a deflation of the price earnings ratio. Okay, that's that's very clear from this chart, and it actually makes makes a lot of sense. The other chart below is kind of similar. It shows the CRB index, the commodities index with the earnings yield, and it's the same story. When commodities are going up, the earnings yield goes up, meaning the P has to come down, and vice versa. And so basically the stock market is not has not been adjusting to the increased in the inflation rate.
Right. So, Albert, let me just stop you right there for 1 second. The bulls would say, well, that's because the inflation's transitory, and you're just taking the CPI, which is short term, the next 12 months or whatever, what we've seen the last 12 months. And actually, if you look at longer term over the next 10 years, 5-10 years, and you look at the 5-year forward, blah, 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 the market's projecting inflation is only going to be 2.5-3% 5 years from now. So really, it's a duration mismatch, Albert. You're taking a short-term CPI thing and comparing it, to a long duration asset. So there's a question here. So if the market's wrong, well, let's say the inflation expectations are correct and that inflation will come back down. Would that make you less bearish? Or put it another way, if the market's wrong, then inflation is going to remain subdued. Then in fact, inflation is going to be high for a sustained period of time. Then the equity market has a real problem. So how do you think about this sort of this BS transitory argument? And anyone who says it's transitory, and by the way, I'm going to go nuts. If anyone brings up used car prices in the March CPI numbers, they're going to be permanently banned from this room. And the reason I say that is those jackasses that have been saying that on CNBC for a year now, they've been completely wrong. And as a matter of fact, if I'm not mistaken, if you look at the latest used car data on Car Gurus, it's actually going back up again. So people who think this whole thing hinges upon used car prices, they're completely missing the story. Sorry about it, Albert. I had to just throw that in there. So, what is your thought about short-term duration, short-term fluctuations in inflation vis-a-vis the valuation on a longer-term asset of equities? I guess that's the question.
Okay, so two things. I mean, first of all, if you look at the earnings yield itself, or the PE, we're not talking about we're talking about a market which is overvalued in absolute terms. In any case, I mean the price earnings ratio, especially when you look at it cyclically adjusted, is just sitting at a very, very high, historically high level, comparable to 2000 and other sort of peak in the market. So you're already looking at at a market which is extremely expensive, no matter the underlying economic data. The transitory argument, I mean, I don't have a clue, but what's certain is that the transitory argument was one which kind of died in the fourth quarter of last year, and in fact, the Fed pivoted out of this transitory thing, way before the the invasion of Ukraine by Russia. So I think it's kind of a gimme that I don't know if inflation is going to remain at 7%, 8%, or go down to 5 or 4 or whatever, but certainly it's not going to 2, let's say 2%, which used to be the old target, anytime soon. And the question is, what kind of interest rates you need to to tame an inflation rate which is at 4, 5, 6, 7, 10, whatever the number. And the point is, it's certainly not a quarter point rise in interest in short-term rates from 0 to 0.25, or a series of rises of half a point. And in fact, the market, I mean, the Fed is behind the curve, and this is what you're seeing the adjustment at the long end of the market. This is why the bond market is collapsing, and at some point the Fed is going to meet the long end of the yield curve. I think the Fed fund. So I think whether it's transitory or not transitory is kind of irrelevant. I mean, right now there's a huge dislocation. Nobody knows whether where inflation is going to go, but between the supply constraints, the this invasion of Ukraine, the sanctions, which are unlikely to, unless Putin gets out of the picture, but the sanctions are probably there for a number of years probably. So the supply side of the energy and commodity complex is going to be constrained. um, we don't even hear anything about what's going on in China, but some of the largest cities in China are completely locked down right now, and nobody is talking about that because the main news is about Ukraine. But it looks like the supply shock is far from over, and the question is probably how long time it's going to take for demand to go down, and for economies to get in a recession, so that inflation starts going down, and interest rates
Right,
start going down as well.
Albert. So you're kind of, we're on the same page here. Unless Jerome Powell, what you're saying basically is, I think someone said this the other day. Unless Jerome Powell discovers his inner Paul Volcker, unless
Yeah.
Jerome Powell discovers his inner Paul Volcker, inflation is going to be higher than people would want. In other words, again, the line I've used, and you echoed it, the Fed is so far behind the curve they can't see the curve. So, in your view, unless they really, really get tough, and for political reasons, I think that's very unlikely, inflation is likely to be a continuing problem. Is that kind of what you're saying?
Yeah, although I wonder if they're not going to be quite aggressive on the on tightening, for at least one reason, and that's, I think, I think they would like interest rates to be, short-term rates to be as high as possible, as quickly as possible, because then they can decrease interest rates, when the economy gets in trouble. I mean, right
Right.
now the Fed doesn't have any bullets,
Yes.
to curb, to curb a recession. And on the federal government is it's even worse. I mean, they can't, they can't spend more. They're also going to have to increase defense spending, considerably. So they can't give away money the same way they've done it, during COVID. So really, the only one that could do something is the Fed, but the Fed is a bystander right now in terms of, if a recession was going to come. So I think they probably want to jack up interest rates, higher and faster, so that they can backtrack, when that will be necessary. And what I think is whether the recession is going to come before the inflation starts to
Right.
go down,
Yeah. No.
or not.
Agreed. Agreed. Okay. So we've gone through the first two slides where you show, and just if you can follow, I know it's a little bit hard, but we've gone through your first two slides where you show the CPI racing ahead and how higher inflation is going to call multiples contraction. So now let's move on because you got a lot of information to get across here. And
Okay,
now on
so
slide 3, you're talking about profit margins are likely to be squeezed, and
yeah,
also you
so
show a graph. Yeah. Go ahead.
if we look at this chart, which shows the the S&P, and the blue line is the enterprise value to sales ratio for the S&P, or the price to sales ratio, and the green line is the operating margins. Now, the P is one thing. The other thing, which is more important, I think, is enterprise value to sales. And in fact, the P is a function of the enterprise value to sales and profit margins. One thing which if I go back to the market has been overvalued, and it's been overvalued for years. I mean, it's not new. Um, and personally, I thought the COVID crisis was going to be the thing that would make it. I mean, that would break the market, and it didn't. It didn't because the interest rates went down to zero again. The federal governments, I mean, not only in the U.S. but all over, all over Europe, Japan, governments started to give away money and so on. And so not only the market went up, tremendously, from the lows of the COVID crisis, but the most amazing thing is that companies were able to rebuild their margins out of the first quarter recession. And not only that, these margins were reached another all-time high at the beginning of during 2021. Again, because of the various economic forces that are at work right now. Inflation, especially the rise of the PPI, producer price index, components, all these things. I mean, it would be extraordinary if companies were able to maintain their profit margins at a very at the current very high level. I mean, I think at worst they did, or at best I don't have to say. I mean, they would go down to 2020, but I think if we get a recession or if we get a major slowdown, the profit margins have to come down. And if you have the profit margins coming down with enterprise value to sales at an extremely elevated level, I mean, this is basically the recipe for a huge P contraction.
Albert, I'm just as bearish as I was before this call started. I'm getting more bearish as you speak. So I would just urge you. We're getting the slides up here. I'm putting them up, and Sohaib in turn is putting them up in the nest. I think we've got about 16 up so far, and you've got a lot of slides. So you've got so much information to give us. I would just say we probably should try to move along a little faster. So you've got the great slide of the profit margins. You should have the consumer sentiments falling apart. Now, I don't know if you see the next group of slides. You have charts of gold, oil and gas, Brazil, et cetera, et cetera. So I don't know where you want to go with this, my friend.
Okay, so let's make it short on the issues of the market and then where to hide. Okay, so I mean basically it's a gimme that the markets are very overvalued. The most overvalued space is large cap tech. And I have a few charts there. In particular, I show the EV to sales of Apple.
Exactly. You've got one chart. Let me just help you with this a little bit because it's awkward. I think what I think we'll do when this call's over, we're going to put all your stuff in a PowerPoint and put it up in a neater fashion. This has been kind of awkward. We're trying to figure this out, but let me just speak to a couple of the charts you have here and make it easier for you because I think I can see them more readily than you can. So, for instance, you have one graph here. You show the value spread between cheap and expensive stocks is extreme. So the expensive stocks on the market, you just think they're potential disaster. I mean, they've been a disaster. You think they're going to continue to be a disaster? Is that correct?
Yeah, I mean the overvalued stuff. I mean, basically the value to growth, the growth to value spread is as high as it's ever been. I mean, it's starting to come down, but this is like I mean we're actually higher now in terms of growth to value than at the peak of the 2000 bubble and in 2008. So that's got to come down. I mean, growth is
right, but I guess to be a little bit fair, and I know we have Michael Kantrowitz in the house, and he's one of my favorite strategists, a great thinker, and he's rightly pointed. I mean, look, the earnings on a lot of the growth stocks have gone up a lot, so. I guess you just have a simple chart of growth versus value. I mean, you've been totally right. I think you got to get a little bit more specific, though. And I want Michael's made the point. I think he's totally right. It's not just the crazy Cathie Wood stocks on one extreme, but there's also sort of like zombie value stocks, which maybe look cheap in price to sales, but they got a tremendous amount of debt and whatnot. And he's made the case. I think he's right. I don't know what you think about this, but it's not even so much a question of growth versus value. It's more avoiding the extremes on both ends and sort of quality growth and quality value as opposed to expensive growth and dumb value. And so but I generally speaking, I think you're right. I mean, I think but whatever. So but
look,
sorry, go ahead.
No, I was going to say,
go ahead.
I was gonna, I mean, obviously the let's say the Apple and Google and so on, the quality, the quality growth, if you will. But I mean, the point is, I mean, obviously, these stocks tend to be always expensive, granted, but they also can come down, 50%. And in fact, if these stocks don't come down, the S&P is not going to come down, or the Nasdaq 100 is not going to come down. So
okay, so you have a chart. I'm just going to pick from some of the charts because we could go. You and I mean, I think back over the years, finally our conversations, we talk for hours on this stuff, and I don't want the people on this call to suffer through this. So I'm just going to pick on some of the highlights or lowlights. Okay, so you have it. So let's speak to this. Is usually timing is always hard, but I want to drill down on Apple because. Apple and Tesla, because that's kind of where people have been hiding. The charts, as you and I had a conversation earlier this morning, it looks like the market's starting to come for those. You have one graph up here where you say, could Apple fall by 50%? You bet. Could you just speak to Apple and like why Apple to you looks so vulnerable right now, and Tesla? So focus on those two stocks, please.
Okay, I mean the case. I mean, first of all, so Apple is selling on 7 times earnings, 7 times sales revenues. Okay, and this is like I can't remember what the market cap of Apple is. Yeah, how many trillions? But
it got up to about 3 trillion. I'm not quite sure where it is now, but go ahead.
But anyway, so 7 times sales is a multiple that was never achieved by Apple. Not even not even in the years after the IPO of the stock. I mean, so in other words, this is a 3 trillion market cap company whose multiple is higher today than when the company was, let's say, an emerging growth stock. So I mean, from that point of view, that doesn't make sense, because it means that the market is expecting, let's say, as much growth now going forward than when the company was, let's say, a $10 billion market cap. So and that's not going to happen. Otherwise, Apple is going to be bigger than the entire stock market. The one of the function of this very high EV to sales ratio is the fact that Apple's got extraordinary high margins, and the question obviously is whether these margins are going to be sustained over time or not. And my view is that they cannot be sustained, because whenever margins are out of the ordinary, you do get new entrants, whether you like it or not. And even though Apple may have very high barrier of entry in terms of its product and so on, I mean today you can buy Samsung. I mean there are basically two very good mobile phone manufacturers with as many services for each other. One is Samsung, which sells on maybe 1 times sales, and Apple, which sells on 7 times sales. And so the disconnect is just too big. And so if Apple was going to go down 50%, with an EV to sales of 3.5, that would be the slightly lower than the EV to sales that was reached in 2007, 2008, just before the crisis.
Right.
So
so
the valuation expansion has just been out of this world.
Right. Okay. So it's like we pumped up the bubble with all this liquidity, and now you're saying the bubble sprung a leak, and now the tide was coming in liquidity. Now it's going out. It's like a giant macro trade. So before we get into hold on. Before we get into more individual names, just so people don't get lost in the weeds, it's not just Apple. You have some graphs up here I really want you to talk about. And again, I apologize for the technical aspect of this. We had some problems getting all this up, but you have a couple charts, which on the U.S. bond. I want you to speak to the interplay of the relationship, the valuation relationship between the bond market. You've got some graphs up here, the 30-year, and the chart looks horrible. It looks like yields are going to continue to go up. And then as it relates to, let's just pick on the QQQ as a proxy for growth. So could you speak to your view of the bond market, one, and then two, you may say, well, gee, the QQQ hasn't gone down enough just to keep up what's happening with bonds. So where are bonds? Where should the Qs be on the basis of where bonds are now, and where you think bonds are going to go, and what does it mean for the QQQ? And then we're going to talk about individual stocks.
Sure. Okay, so I mean, just the just looking at the chart which shows the 30-year and the 10-year.
Yep.
So without having a PhD in economics, I mean the charts are just looking horrible. So I mean yields have broken up on the I mean they had a breakup on the chart, and it's I mean I think we go easily to 3.5, whether on the 10-year or on the 30-year.
Whoa! Stop press. So I actually tweeted out the other day 3.5 on the 10-year. So Albert, doesn't that mean Tina? There is no alternative. Tina is dying, if not dead. No.
I think it's pretty dead.
Yeah.
I mean, I mean, it's so cliche, as we would say in French.
Yeah. No. Exactement, mon frère, mon ami. Okay. So
I mean,
okay.
look. I mean, the thing about Tina and FOMO and all this crap is I mean, first of all, there's always an alternative, including even in a 7% inflation. you're better off in cash than in a market that goes down 30%.
Yeah,
So
no,
that's
100%, 100%, 100%. All right,
so.
so to make it easier for Albert, let me just read to you from some of the slides that you put up, and then you can weigh in. So, and again, I apologize, everyone. We have some problems getting all this up, but you don't like Apple, you don't like Tesla. Um, you got a chart of the Qs. You think this thing can go a lot lower. Amazon looks horrible to you. You just put up some big names that people recognize. Amazon looks horrible. Microsoft looks horrible. I mean, basically, you're saying all this large cap tech stuff. Forget about the earnings. The valuations just got so inflated because of liquidity that it's not even so much about the earnings. Earnings may go down. Who knows? That's not the point. The point is the valuations are completely out of whack, and the charts are horrible. And if I read you correctly, you think all these large cap tech stocks, all this expensive growth stuff, is just going to get completely destroyed now. Is that a fair summary of your belief?
Yeah, I mean that's what I think. I mean, I think it started with ARK and the ARK. I mean, all the bullshit tech stocks with no earnings and crazy valuations. I mean, that was that peaked in February last year and has been going down relentlessly for the last 13 months, and I think it's not even finished. But once, I mean, it's a question of, I mean, there is an asset liquidation phase going on. And I think once people have, I mean, by and large, people have finished to sell some of that crap. And once they sell that, what else are they going to sell? Well, they're going to sell the next thing, which is the next tech thing, which are the big ones. And it started with Facebook, which had a very bad day, a couple months ago, and the same happened with Netflix, and probably a couple others. I can't remember the names, and so it goes in a roll, and I think all of these stocks are not going to escape the selling. And if you look at Facebook and Netflix, I mean, if you look at they can't even rebound. I mean, they can't rebound. Even though they do look cheap when you look at especially Facebook, maybe looks cheap within the tech space, let's say. But I mean, they can't rebound. ARK cannot rebound. The Chinese tech can't rebound. Most of the crap that has gone down, nobody's buying these things. And it just shows that the flow of fund is is on the exit. And again, the fact that interest rates are going up and are probably going to continue to go up. I mean, it's mathematical. I mean, you can't escape the fact.
All right.
That interest rates go up, PEs are going down.
Albert, Albert, we could talk forever, get a bottle of wine, and we could talk about which tech stock we hate more than the next one. But just before we open up the questions, maybe just talk a little bit about what you kind of like. I mean, you got some charts in here. You look more favorable. You kind of like Argentina. You like Brazil. You like precious metals. You put in a chart of Newmont, et cetera. Maybe just briefly touch on some of the areas that you think look interesting, if not on an absolute basis, because we do get a big bear market, maybe everything declines. But if not on an absolute basis, certainly on a relative basis. I mean, if you say Argentina and polite company, most people will call for the men in the white coats and say, this guy's crazy. We know you're half crazy, but I know you like Brazil, you like Argentina, you like gold. Just speak a little bit about those, and then we'll open up to questions.
Okay, so on gold, it's on gold, it should be relatively obvious. I mean, given the geopolitical uncertainties and inflation, so I mean, you've got the two things going for it. And gold has been going up and breaking out in virtually every single currency. I think we still haven't broken the 2020 highs in gold. I think the break is 1980. I think if we break 1980 on gold, I think this is going to go parabolic.
Al, I got to interrupt you. Isn't gold, though, in every other currency, like gold in euros, gold in yen, gold in anything else, isn't gold pretty much at all-time highs in all these other major currencies?
Yes, except
okay.
I mean, the high for the dollar was in 2 years ago. Okay, but
right,
but
I know.
otherwise,
okay, right, okay, all right,
okay,
but most of the folks on this call are in North America, and so they're looking at gold through the lens of the U.S. dollar, the Canadian dollar. The point is, if you're sitting in Europe or you're sitting in Japan or whatever. I mean, gold's at an all-time high right now. The chart looks fabulous. Huh? Okay, all right, that's great. All right, all right. So you like gold as you like gold as an inflation against the what's happening. Speak a little bit about Argentina and Brazil, please.
Okay, so I mean, just to finish on gold, 1 minute.
Yep, go for it.
I look a lot at arbitrage situations between commodity stocks and the underlying commodities, and actually, it's in the gold and silver space that the stocks are still very, very cheap compared to the underlying commodities. I mean, like if you look at copper stocks like Freeport, versus copper, the stock is very high relative to the underlying commodity. If you look at gold mines versus gold, or silver mines versus silver, the stocks are very, very low compared to the underlying commodities. And I think they I mean, being a gold analyst, I mean, doesn't get you a job anywhere these days. You look at I mean, most of these gold stocks are very cheap in, even in P's or EV to EBITDA, and some are paying dividend yields and so on. I mean, they've never been so cheap in value terms. And I think it's I think if gold breaks out, 1980, 2000, I think the gold mines are going to explode at that point.
Right, and Albert, can you just I just want you to go back on one point. It's very critical. You mentioned how the precious metal stocks, the gold and silver stocks, are very cheap relative to the underlying commodity. But you are saying for like the Freeports and some of the mining stocks, it's not the case. Like if you want to be long copper, or you want how copper is going to go up, you actually think it's probably better just to own the metal than the stocks, or put it out. The stocks are very expensive relative to the metal. Is that what you're saying?
Yeah, for the time being, yes. Yeah.
Okay, and what about? And I know you like oil and energy, I believe. What about the oil stocks relative to oil?
So it's. I mean, the oil stocks are. I don't know if I would be buying. I'm not sure I would be buying oil stocks outright, because I mean they have gone up a lot. They relative to the S&P, I mean they are at if you take a 10-year chart or 20-year chart, I mean you don't even see them going up on a relative basis. So we probably just at the very beginning of the if you take a short-term chart, it looks extended. I mean the way we play it is being long the oil sectors, short the S&P, and then short oil, because I mean clearly if oil goes down, and I don't know, I mean probably it's not going to go down, but let's say tomorrow you get some kind of an agreement in Ukraine, oil goes down, $10 or whatever it is, and the oil stocks will probably go down, a lot. So we look at it on a hedge base. But I mean certainly,
right. Okay.
It's the same story. I mean let's say the XOP or XLE, whatever. I mean Exxon. Whatever you want is probably a much better bet anyway than being long QQQ or the S&P.
Yeah, no, all right. So you think the energy stocks will certainly outperform the market? That's for sure. Okay, but on an absolute basis, you don't know. Okay, fine. Last thing, and then we're gonna open up for questions.
Okay, so
hold on. Can you just speak to Brazil and Argentina, please, and then we're gonna go to questions.
Brazil is, Brazil is again is a commodity story. With an undervalued currency, so the again on a relative basis, I think Brazil. If you long Brazil, short the S&P, or short the world index, I think you would be doing very well going forward. We have a graph somewhere, so I guess George, I'll put up some kind of a package with the charts in order. But we have a chart that shows the Brazilian stock market versus the S&P and versus commodities, and basically the Brazilian market is basically on a takeoff ramp versus the S&P, given where commodity prices are. So commodity prices are so high that it's not been yet reflected in the relative performance of the Brazilian equities versus the S&P. If you look at the Bovespa index, the two largest market cap, and it's a pretty big part of the index. One is Petrobras, which is one of the major oil companies in the world, and the other one is Vale, which is one of the biggest iron ore company in the world as well. So I mean Brazil is very commodity related, and and the country, benefits a lot, in upcycle of commodities.
So I just want to understand. So you're actually saying Petrobras and Vale actually look okay to you? Is that what you said?
Say that again. Sorry.
You're saying you actually like Petrobras and you like Vale? Is that what
No,
you're saying?
I'm not. I'm not sure I would be buying the individual stocks, but I was just saying that they are, they are very big weighting, within the Bovespa index.
Got it. Okay, that's great.
Within the, the Brazil ETF.
All right, that's fantastic. All right, so
Okay.
let's just stop right there. I apologize.
No, wait. I want to give you this. I want to give you the 1 minute on Argentina.
Yeah. All right. Yeah.
Okay.
Don't cry for me, Argentina. Go for it.
Okay. So Argentina. I mean, if Ukraine is supposed to be the breadbasket of Europe, Argentina is the breadbasket of Latin America. I mean, it's one of the richest country in terms of agricultural land, and it's also an oil producing country. So I mean, this is really a commodity play as well. Now, the story of Argentina is one of booms and bust all the time. They signed a debt restructuring plan with the IMF about 3-4 weeks ago, and according to people that watch Argentina closely, I mean, this is possibly the way that Argentina is going to get out of its last crisis. Now, there's a very interesting angle, buying Argentina. I mean, first of all, there's quite a lot of ETFs which are trading in New York, relatively liquid. One of the biggest one is YPF, which is an oil company. It's the national oil company. It's trading at maybe on 3-4 times earnings and 0.3 times book value. It's got enormous gas reserves. The chart is somewhere in there, but I mean the stock is down, I don't know, 80% from its high.
Right.
And you
That's
look
great.
at any Argentinian ADRs, it's the same story. They're trading on, there are banks which are trading on 2 times earnings and 0.2 times book value, and so on and so forth. And by the way, Argentinian banks have never lost money in the last 20 years, despite all the crisis over there. So
right.
Now the angle with Argentina, which I love when buying ADRs, is that the Argentinian ADRs are trading at a 40-50. I mean, right now the discount to the local shares is 40%. Okay, and why is the discount? I mean, you may ask why there is a discount, and the discount reflects. I mean, there are 2 exchange rates in Argentina: the official exchange rate and the unofficial black market, parallel exchange rate, whatever you want to call it. And the ADRs are priced on the parallel or black market exchange rate. They reflect, what the real exchange rate is versus the official exchange rate. Now, each time Argentina goes into crisis, there is there's a huge spread between the official exchange rate and the black market rate. It's sometimes it reaches 2-1. I mean, there's like a 50% discount on the ADRs. It happens every 10 years or so. And then when Argentina comes out of a crisis, the black market exchange rate, the black market exchange rate goes towards the official exchange rate, and the discount on the ADRs disappear. So in other words, even if Argentina doesn't do anything, the stock prices don't do anything. If the country gets out of a crisis and the exchange rate, become the same, you would almost double your money just by the discount disappearing.
Got it. All right.
But okay,
all right.
but
That's right. So, Albert, let's just hold it, please, because I really want to get some people in here on questions. All right, that's a brilliant sort of tour de force. Let's go to some questions. We got some really smart people in here. I'd like to. KFab has his hand up, so we're going to do KFab first, and then Michael K, if he's listening. Always love to hear Michael Kantrowitz speak. So KFab, you're up. Michael Kantrowitz, you're next. So KFab, what's up?
Hey, George. I haven't spoken with you in a couple of weeks. Had a health issue, and just wanted to congratulate you on what you've been doing with the health kitchen. So, Albert, I don't usually talk about individual stocks on these spaces very often. I think the last one I talked to about with George was Buena from Peru back in late fall. But you've inspired me with some of your discussions today. what do you think of Cresud out of Argentina, the ag company? Again,
Okay, so I mean, I know Cresud. I know Cresud very well, and it's my number one position.
okay, well, enough
okay,
said.
okay, so I love it. It's
Yeah,
run by a crook, but what can you do?
right.
But as you know, it's the biggest or one of the biggest agricultural landowner in Argentina, and it's via IRSA. It's the biggest commercial real estate owner in Buenos Aires and in Argentina as well. So, this is a stock which I think, again, just by the currency adjustment can double. Even if the stock does nothing, but they actually own extremely valuable assets. So I think the stock could easily go three times, four times in a
Okay,
cycle.
right. Yeah, it's one of my favorite ideas. So that's great to hear.
And you
The
and
other one that
you have a similar you have a similar company which is bigger in terms of market cap and better known, which is called Agro. I mean, I can't remember the name, but the ticker is AGRO. It's a Brazilian company with an ADR.
Okay, great.
That's great.
I'll look at. Yeah, just real quick there. The other one's Bayer. With the it's got Monsanto buried in it, and it's actually one of the cheaper European stocks that I look at. So just curious if you've looked at that.
I've looked at it. I mean, I haven't looked at it in detail, but I know the angle with with Monsanto. But I
So
haven't. I haven't done.
KFAB, again, it's not investment recommendation. I get it, but what's sort of the elevator pitch on Bayer, KFAB?
Yeah, it's basically that for obvious macro reasons, and being in the bad neighborhood, you've had Bayer be very underperforming. And in a market environment globally where there's not a whole lot that you can look at that's relatively cheap, you've got a large division in that business that is Monsanto, which you know you look at what's going on in other ag stocks and ag companies. So whether it's some kind of realization of value, a corporate transaction, that kind of thing, it's a sum of the parts type of thing, and relatively conservative way to maybe get some
Right.
exposure,
Got it.
3% dividend yield, that kind of thing.
Yeah, no, it sounds very short. It sounds great. All right, so before we go to Michael K, I just want to say a couple things. One, if you are requesting to come up on stage and ask a question, and I don't know you, you need to DM me with what your question is, because one of the things about these rooms that everyone seems to like is the way I moderate, and we keep the conversation on the rails. We don't go into extraneous things. So if I don't know you, I've sent you a direct message, or you must direct message me, because I need to know what the question is. Nothing annoys me more than someone comes up with an irrelevant question. We're in the midst of, say, this happened like a few weeks ago. We're talking about energy prices and oil and the Ukraine and the SPR, and the guy wasn't being. It was a perfectly okay question, but it's totally out of context. So, hi George, it's the first time I've been in this room. What do you think about dollar cost averaging? I'm like, come on, it's just wasting everybody's time. So if you have a question, if you you're requesting to speak and I haven't recognized you, it's because you need to tell me through a DM what your question is, because it's just not fair to everybody else in the room. Couple things. Albert, he has a research service. I have no commercial relationship with Albert, but he has a research service that he has always looking for new clients, I'm sure. Speak to him about it. You can reach him on Twitter, or his email address is albert@aimr.ch. That's albert@aimr.ch. Heretofore, he's got really high end institutional clients. I don't know that he has too many individual clients, but he's always looking to build his business. If you're an RIA or something, I'm sure he could probably figure out some commercial relationship with you. I mean, he's normally charging tens of thousands of dollars for his research, but I think he probably would be interested in having conversations, at a lower level of service. So again, it's albert@aimr.ch. And the other thing that was mentioned earlier, thank you, KFAB, for citing it. We've tried to enlist this room in service of raising money for those less fortunate. I'm going to pitch again. I feel like one of those guys on public television. We're all very fortunate in this room. This is we're dealing with first world problems, how to preserve or increase our net worth. There are people out there who are really hurting, and in particular, we focused. I want to call out my colleagues, Carol Strone, Andrew, RJ, and Jack. We've all kind of banded together to try to make this a force for good. It's in my Twitter feed. I'll put it up there again. But we selected a charity. It's World Central Kitchens. Chef Andreas is doing an unbelievable job going to the Ukraine, cooking hot meals for people. I think there's 3.5 million refugees in the Ukraine, and they're cranking out 300,000 meals a day. They get extremely high ratings from all the charity services in terms of their efficiency, and so I'll put it in the Twitter feed again. We provide a link that goes directly to the charity, so we do not benefit at all. But if you get value from these rooms, pay forward. I mean, to have people like Albert Saporta or Tom Thornton or Jeff Garbaz or now Michael Kantrowitz is not making a presentation. Hopefully he'll make one in the next couple of weeks. Michael and I talked about it, but people pay good money to listen to Michael speak or to listen to Albert speak, and so everyone's telling me how great the content is in these rooms, and we have like 20,000 Twitter followers, and they're getting as many as 25,000 people an episode listening to these things. Well, if you got value for it, this is the sort of thing that normally you have to pay thousands and thousands of dollars for it, and we're doing it for free. So I urge you, I implore you, I beg you to give to World Central Kitchen. The links to my Twitter feed. Pay forward, give to those who are less fortunate. Okay, so with that, Michael Kantrowitz, my good friend. I think probably knowing the way you think and look at markets, there may be an emerging bromance between Albert and yourself because you're both sort of quantitatively oriented. So I'm sure you got lots of questions, objections, whatever. Good to see you, my friend. What's on your mind, Michael? The floor is yours.
Hey, thanks, George. Can you hear me okay?
You're good. Go for it.
Okay. I guess I could follow up on the comment about growth and value. I think it's a ongoing debate, and it always will be, and it will continue. But I think you got to go a step below that, as you kind of highlighted too. Because I think when you look at the market now, there's a lot of junky growth stocks that are just continue to get hit. They're expensive, no earnings, et cetera. That's not where you want to be. Even if rates were going lower, I'm not sure I'd want to be in some of those anyway, given their valuations. But on the flip side, there's plenty of crap in value that is performing as bad or even worse. So, for people that are saying I would say to go out and buy a value ETF here, I think it's dangerous. If you look at auto stocks, those have gotten crushed. Those are deeply cyclical. Bank stocks performing terribly, also kind of the poster child sector of value. And then when you look at, we do a lot of quantitative work looking at factors in a sector neutral way, which tends to be the better way to observe the data rather than looking at industries and sectors, which can be manipulated or traded based off more macro events like rising rates or rising oil. When you look at value factors, they're all rolling over in the last 4 or 5 weeks. And so I don't think this is a market that's really any longer bifurcating wins and losses by growth and value. I think it's going to be increasingly going forward less about valuation and more just about visibility, sustainability, strong balance sheets, and profitability. And so the answer is, it's not growth, not value. It's somewhere in the middle. That's what George and I have talked about a lot. And that's, I'm just going to be curious to hear what Albert kind of thinks about that.
Yeah, Michael, thanks. I mean, you really, what you said really struck a chord. That's why I'm trying to channel my inner Michael K. I think you're spot on. So, Albert, what do you think of Michael's idea? It's not just obvious. Listen, being short Kathy Woods is kind of sort of Captain Obvious 101 first order thinking now. It's down 60%. It'll probably go down another 60%. But let's not worry about that. The more interesting part is, sort of the high beta leverage garbage value, which at this point in the economic cycle, it may look cheap on EV to sales, well, actually on price to sales, maybe not so much in EV to sales. But given that a lot of these companies are economically sensitive and in many cases have low profit margins and a lot of debt, that could be a pretty dangerous place to be long. So I think that's kind of that's the less obvious part of where what you would want to avoid. Did I phrase the question correctly, Michael?
Yeah, just to kind of maybe solidify. I know you said large cap growth seems to be your least favorite corner of the market. If we think large, mid, small growth, core, and value, does that mean small values your favorite part of the market? And I'm being a little snarky there, but I'm curious to hear.
Actually, the interesting thing is that growth is at a historically very high premium to value. But the thing is that if you look at value by itself, you look at the Russell, any of the Russell, but especially the like the Russell S&P, the S&P value, so the large cap value stocks. These stocks are also trading at historically high valuations. So, value is cheaper than growth, but value is also, is historically very, very expensive on an absolute basis. And that's the thing. And that's where, when that, you are in a true bear market, I think is, there are very, very few places to really hide, especially on an absolute basis. So, I don't have, and when you talk about growth versus value, it also depends what you look at. I mean, if you look at the Russell, it's a different story than when you look at the S&P, growth versus value. So in the large cap area, actually in the, if you look on this in the small cap area, the small cap got destroyed as well. But in the large cap area, it hasn't really happened yet on either growth and value.
Right.
Yeah,
that's fair.
I guess just a follow up to that. I think
so. You look at I don't know where Caterpillar, for example, is. Whether it's in growth or value. I have no idea where it is. But you look at stocks like the big industrial stocks or the material stocks. I mean, these things are trading. They're trading at very, very high absolute valuation levels.
Right. So I guess, Michael, I guess what it's really boiling down to, there's the relative argument, which is one question, and then there's the absolute. So I don't know, Michael, if differentiating between relative and absolute, if you would, what you're thinking. Albert's basically saying everything's going to go down. Okay. And now we're getting into on a relative basis. So I imagine, you're advising, very large institutional investors who have to be invested. So you're making a lot of relative calls. But I guess what I push back to you, Michael, on, and you've been very spot on, so my hat's off to you. I'm not being snarky. But what I would come back to you, if you were to put on your absolute hat, not your relative hat, your absolute hat, what would you say? Because I think that's what Albert's looking at. What would you say, Michael?
Yeah, I think there's very, very little upside in equities until we reach a point where the global economy starts to reaccelerate in terms of economic activity, and we're just in the third inning of a global slowdown. So, I think to the extent there's any upside in equities this year, it's if we get any positive news events from all of the issues that are currently plaguing the market today that are not about the momentum in the economy. So high inflation, the Fed, Russia, Ukraine, all of those. If we get any good news, like you said, oil drops $10 if we get a good situation turn out in Ukraine, the market goes up for a couple of weeks, but then realizes, okay, we're still in a massive global slowdown. And we just, we've been chewing on higher rates, higher oil, and higher everything for the last 18 months, but we're just beginning to digest it. And that digestion process takes a year and a half. So I agree, not much upside. I think small value has the most downside here. So again, what's the major story going to be going forward? I think it's more about a growth shock, right? We've had shock. George, you checked them all off, right? Rate shock, energy shock. Where's the growth shock? That's next.
100%, Michael. Okay. So actually, it's really interesting because I mean, Albert, when you come to New York next, I think we have to have lunch with Michael because you guys, I think, would enjoy each other immensely. I think the only extent to which there seems any seeming disconnect is because we're talking about multiple time frames. So that's excellent, Michael. Really, really appreciate your input. All right, let me move on here a little bit. I want to go now to my good friend Shrub. He's always been great. He's a really smart guy. And Albert, he's in Monaco, so not too far from your neck of the woods. And Shrub always has really insightful comments, particularly about the flows And so, Shrub, I'm kind of curious, what did you see in terms of flows and also the market action this week? So what's sort of top of mind for you, Shrub?
Hey, George. Thanks for having me. Thanks for doing it again. I actually don't have data for this week, but look, the inflow data has been quite strong still. So again, I was looking at one survey by Bank of America that said the record number of respondents were pessimistic about the economy, worse than Lehman. So it was 72% of respondents said that they're pessimistic about the economy, and I think at Lehman it was a bit below that. So investors are more pessimistic than during Lehman. We're talking about $1 trillion AUM. So when they do these polls, they ask about $1 trillion of AUM, and then they ask them about allocation to equities, and their allocation to equities are just about normal. So,
I mean, Shrub. You can't make that shit up, okay? I mean, excuse my French. I mean, it's insane. And this goes to the Walter Deemer quote about, it's not when people turn bearish that counts. It's when they're done selling. They haven't even begun to sell.
George, they're going to sell at the bottom. That's what they always do.
That is the way it always works. By definition, it's identity.
Yeah, by definition.
Exactly. So,
yeah.
so they haven't sold a freaking thing, which is why I keep coming back on the equity market offers return-free risk. All right, keep going, Shrub. And Shrub, by the way, as we're talking, I'm going to dig out. I did find a funds flow data stuff. I'll email it to you. Have a look at it, and then maybe you could weigh in because I think it showed outflows. Keep going.
I think it. So some other data showed outflows, but the Bank of America one didn't come out this week that I saw. So the other data did show outflows in the U.S. But look, I mean, let's just take the worst one. So ARK. I mean, I tracked the ARK flows. People haven't redeemed out of ARK. She made $80 million in management fees this year. I mean, that's not a bear market, guys. I mean, I'm sorry, but this is not. We're nowhere near yet. You have the Tigers down 30%. You have ARK not having major outflows. You have venture capital just taking the first hit on their marks. And just another stupid data point. So, I think I have a decent following on Twitter. I talk a lot of nonsense on Twitter, but then when I put the performance of Tiger, and I said, this is ridiculous. They just, because what Tiger did, let me just clarify. They're down 30% on the year, and they took a big hit on their private investments end of March. So my comment was, why did they do it end of March? Is it to get the bonuses in December? I mean, the market was bad in December. Why is it end of March? And I got so attacked by pretty much half of FinTwit on that point. So I think there's still complacency.
But Shrub. And we're going to have, by the way, there's a special guest lurking in the weeds, Mr. Flowpoint Partners. So there was a great Twitter thread the other day, and sorry to interrupt you, Shrub. There was an epic thread, and I'll retweet it, put up by this fellow about how all the high net worth guys are getting bagged, and it was unbelievable. He's like, one guy was saying he reads Kathy Wood's page every day to get his ideas about the market. I mean, you just want to shoot yourself in the face when you read this thing. So it's exactly what you say, Shrub. They haven't sold a freaking thing. And so let me just hold on here. I hope Mr. Flowpoint comes up. He can unmask himself if he wants to. But I mean, Shrub, this is unbelievable. I mean, they haven't sold anything. And meanwhile, all the macro factors, you heard me talk at the outset, all the macro factors, rising oil, rising interest rates, rising dollar. I mean, it's only a matter of time. So, I mean, have you become, I know, like me, you're a chameleon, you change your opinions, you move exposures around. But are you more inclined? Are you leaning more negative now? Like, where are you, Shrub?
I am still keeping my same positioning I've held for the last few months. I'm short NASDAQ and I'm long energy and commodities. So half my portfolio is that, and I have a decent cash position. I have 20 to 30% cash, depending on my mood. And my main trade is basically long commodities and energy, short tech. And I will remind everyone again to go back and listen to the Stan Weinstein YouTube podcast. Guy, as long as it's working, just keep the trade on.
I mean, Shrub, you know what's so brilliant about this? I mean, that saying goes, you love when a plan comes together. So we start with relative valuation, which totally. I mean, you don't have the same book. So the relative valuation, check. The macro regime, check. The price action, check. Positioning, check. I mean, Shrub, what did I miss? It's like everything points in this direction. I mean,
can I add that?
I get scared, Shrub. I get scared that I'm missing something. I mean,
I'm the same, George. And you know what scares me more is when I speak to a lot of I speak to a lot of retail investors because of Twitter, and I'm having intelligent conversations. And what worries me is when I speak with guys that manage hundreds of millions and billions, and I cannot convince them for my life.
Shrub, I will tell you, and I don't mind, I'll mention names. Some of the smartest guys that appeared in these rooms, technicians. You know, we had Dave Nikoski from Vermilion on the other day, who, by the way, if you guys didn't listen to him, he's another name maybe people don't recognize. Go back and listen to that replay. That was from last weekend. Dave Nikoski, John Roque, Stan Weinstein, Tom Thornton, Jeff Garbaz. I get the same exact story from all of them, which is the same story that you tell me. It's like, Roque will say, he's talking to, I don't mind giving away secrets because he's a good friend. He'll be talking to a guy running, a few $1 billion or one of these firms. And it's like, they don't want to hear it. They just don't want to hear it. Like, you're stupid. You don't know. I mean, the sheer arrogance, Shrub. It's one thing if someone gives you an intelligent, well-reasoned pushback, but the sheer arrogance is just unfreaking believable.
George, I was thinking about this today, and you've probably seen this more than I have. But the old saying that you never get fired if you own IBM.
Yep.
I think it's kind of the same thing now. I cannot justify it in any other way.
I
cannot justify it in any other way.
All right, Shrub. So hold that.
Just one thing. Yep. One thing to mention, which was in relation to what Albert said. So the one thing that is actually very interesting, because Albert started the conversation with inflation, and then he ended with Argentina. And I just implore everyone to look at what multiples a high inflation country trades at. It's mid-single multiples, mid-single digit multiples. So when we talk about inflation and people are saying, inflation is transitory, even if it settles at like 4 or 5%, the S&P should not be at 20 times. Look at all these emerging markets. That's why I was telling with my old firm, we're saying if inflation hits, the only guys who will be positioned well is emerging markets analyst. I'm just going to leave it there.
All right, so now Michael, the floor is yours. What's up, man?
Regarding the valuations, again, I don't think it's so much about valuations going forward. If you look at Europe, it's cheaper than the U.S. Canada's cheaper than the U.S. Everything's cheaper than the U.S. But I'd say that's largely due to composition. If you look at cyclical markets, there's 10 stocks that make up, or emerging markets, there's 10 stocks that make up 50, 60, 70, 80, 90% of the index. And so they're always going to be cheaper. Never a reason to buy it. And so there are plenty of expensive stocks that are still doing well. I'll give you some examples: AutoZone, Costco. And so I think, again, the story is not just about, the stock's expensive, rates are going up, and I got to get rid of all these expensive stocks. What are you going to do if this is going to happen as growth continues to slow over the next 9, 12, 15 months? The market increasingly gets more and more narrow, and what's left is a bunch of expensive defense.
100%.
So it's going to push people out of cheap stocks, because if you're in cheap stocks, you're going to get blown up, because there's a reason the stock is cheap. Again, I think it's as growth slows. And what are you going to do? Either not own equities at all, or what are you going to do when you buy utilities that are trading at expensive levels?
Well,
It's happened every downturn.
Yeah, Michael, if I interrupt, I totally agree with that. But the thing that goes to the absolute versus the relative. Like, I get it. People will pay up for AutoZone, Costco, and a Ute because the earnings volatility and earnings visibility. Earnings volatility is less. Earnings visibility is greater. I get that. For someone who has to be invested, but for this goes to the absolute question. Like, if you don't have to be in the market, like, why in God's name would you own? If you don't have to be in the market, owning the stock like Costco, and we all love the product, owning Costco and 40 times earnings, especially if I say to you I have the Wall Street Journal 3 months from now, and the long bonds at 3.5%. Like, in the world of absolutes, that just makes no sense at all. I mean, what would your pushback be to that, Michael?
And if Costco's going down, I think everything's going down.
50%.
Yeah, no, that's fair.
And I get
Costco down 50.
But I think you have to separate stocks that are expensive on why they are expensive. You can't compare Costco to a stock in Cathie Wood's portfolio. And
No,
Costco is
no,
stupid
no, no,
expensive.
no, 100%. But they'll all go down for different reasons. I mean, each one's different. I
Well,
mean,
here, let's look at S&P Low Volatility Index. I'm sure that has got increasingly expensive and will only get more expensive, certainly on a
sure.
relative basis.
Yep.
That's what you're going to want to own when all of this inflation and
No, yeah,
George, if
yeah,
you're
yeah,
you're
yeah.
right, George, how do we get to 3.5 and not go into recession?
I got the answer for that one really easy. I don't want to go there just yet. I want to go to Mr. Flow Point, but I got you the answer. Don't worry, I got that one. So, Michael, if you could, because so my point is, I think rates are going a lot higher. I think everything goes down. That's kind of where I am. I think Albert, is that where you are, Albert?
Yeah, no, that's where I am. But I mean, I'm glad you're talking about Costco because it's one of I think it's one of probably one of my top short idea. I mean, I don't see how these kind of stocks can continue to to go up. I mean, it is kind of, Costco is probably kind of Tina. Like people are going into there because it's, I don't know, it's a big supermarket and you got to eat or buy some stuff.
It's an annuity. They just make money on subscriptions.
Yeah, but it's not an annuity. I mean, it's a retailer which is trading on again on an enterprise value to sales of, I don't know, 1.2 or 1.3 with operating margins of 3%. And these are things which are not sustainable.
And let me just weigh in. My pushback to you would be, because the argument you're espousing, I love you, man. So I'm not going to be smarky, but I'm going to push back to you in the same way you phrase the question. You can't tell me that even if Costco has earnings visibility, doesn't fuck up, that taking the discount rate, the 10-year from 175 to 275, which you've already done, that somehow that shouldn't go into the price of Costco. And then God forbid, if I'm right, it goes to 3.5, doesn't further smash the multiple. Like, how do you answer that?
I think because everyone, when you think about rates going up and down, everyone always thinks about the multiple, and that's it's a big part of the story. But what about the earnings? What about the top line, the or the bottom? Sorry, the E, in the denominator. What are higher rates gonna? They initially will compress expensive stocks when rates go up, and then the second order effect is they crush earnings for cyclical stocks. So it's definitely more of a relative call for Costco. If Costco goes down 50%, everything's down a
No,
lot.
all right. So we're in agreement. It goes back to absolute versus relative. Listen. None of us here want to own cheap stocks with earnings volatility and shitty balance sheets into a downturn. We're not arguing about that. All right. The question is, it all gets back to relative versus absolute. I mean, listen, if you're my good friend Will Danoff from Fidelity Contra Fund, right, or our good mutual friend Sammy Simnagar, okay, of course you're going to own. You're going to own, Costco instead of some leveraged piece of crap cruise ship company. It's not the issue before the house. The issue before the house is you got a long duration. And by the way, I don't even think Costco's earnings estimates have been going up. I mean, I got to double check that. But the multiple on sales, on profits, on anything you show me is at levels I don't think it's ever been before. At a time when the discount rates are going through the roof. So to just focus on the earnings at the exclusion of the valuation, that's as nonsensical as focusing on the valuation without looking at the earnings. I mean, it gets back to the absolute versus the relative argument.
Yes, George, if I may come in, I think what you're saying is exactly. I mean, is point on in the sense that the fundamentals of Costco here are irrelevant in the same way that they are irrelevant for Apple. The question is one of PE compression. It's not one. It's we've had PE inflation for the last 20 years, and now we're in an environment of PE deflation. And so what was selling at 30 times and 40 times earnings, is going to be selling at 20 times and 10 times earnings. I mean, it's with the same fundamentals, with the same great fundamentals. It doesn't make any difference. And just to put things in perspective, one sec. I mean, just to put things into perspective. I mean, Costco is on 45 times earnings. The last peak, price earnings ratio was in 99, and that was at 30 times earnings, and it went from 30 times earnings to 10 times earnings between 99 and 2008. And previously it went from 20 times to less than 10 times earnings between 91 to 94. So the same company with probably the same growth and so on. So it's not unusual to see great companies going through a P deflation, not because the fundamentals are getting worse, but because the whole market is derating, and and that's what happens in a bear market, basically.
Michael, back over to you.
But I think people are extrapolating what we've seen in the last 3 to 4 months, expecting this to continue. And I think that's wrong, because in the past 3 or 4 months, the only thing people have been concerned about has been things that have been moving higher: inflation rates, oil, dollar, geopolitical risks. And again, I'm repeating myself like a whatever. No one's really concerned. I understand, like, this growth slowdown. It seems sentiment is reflecting some of it, but you haven't even seen earnings really start to get revised lower.
But Michael, I think what's happening here, you're talking past each other. I agree with your point on the slowdown. I channel my inner Michael K in my remarks. But what you're not responding to, and I'm really getting a little bit annoyed about, is the idea that forget about absolute relative. Forget about that. Do not talk about relative. Okay, you're Joe Blow. You walk in off the street. The discount rate's gone up a lot already, and it may continue to go up. Okay, and in bear markets, as I say, and as Stan Weinstein said, or someone said it, in a bull market, the hardest thing to do is to stay invested in the market's going up. In a bear market, the hardest thing to do is to stay out when the market's going down, because everyone's backward looking, and they used to selling 40 times earnings, now it's only 30 times earnings. Always looks cheap on the way down. The pushback, I don't want to get into it's growth versus value. You and I agree on that. That's not the issue we're discussing here. The issue we're discussing is absolutely, would you put your mother or mother-in-law into Costco right here? And if we're in a bear market, which I think Albert's saying we are, the answer is no. How do you answer that question?
I think, again, we think of everything in a process, in a market cycle. And I don't think we're heading into recession over the next 6 months, maybe 9 months. I think 9 months from now, though, beginning of next year, the first half of 2023 is going to be extremely ugly from an economic growth and earnings growth perspective, and all the data is going to be at its hitting new lows every month. When we get there, I don't want to touch anything, but I'd say right now, the next 3 to 6 months, and maybe it's playing a little cute, for the next 12 months, no, I wouldn't. If I had to lock $1 away for more than 9 months, I wouldn't put it in any stock.
All
but
right,
for the next
that's
9
fair,
months,
all right, let's just stay with that. Michael, brilliant insight. Really appreciate that. Albert, brilliant insight. We're all learning here. This is what this room is all about. Nobody really knows. We're just a bunch of ordinary guys trying to figure it out, and together maybe we can. Okay, so now before we go to Mr. Flowpoint, and I'm not going to reveal his name, he can describe who he is. I'm just going to say, again, I'm going to feel like I'm shilling here, but the other day we raised $9,000 in the space that we had. I don't think we've raised a single penny here so far today. So it's up in the nest. You can just get out your credit card. It goes to people who need it. Actually, I take that back. We got one contribution of $50. And we consider the tens or hundreds of millions that's in this room. That's like ridiculous. One of the speakers in this room generously gave over $5,000. I'm not going to say who it was, but if you think you're getting value from this room, again, you'd have to pay gazillions of dollars to listen to Michael or Albert or Mr. Flowpoint or KFAB or Bobby J's going to talk. I think the least people can do is give to people who are in need. And, I do this for no personal gain. I pay forward. I wish others pay forward. I'll call that Sohaib. He's given generously. Shrub has given. I'm just talking about the speakers are up on here. Bobby J has given. Many of you have given. So I implore you all to give. All right. So special guest, Mr. Flowpoint. I'm not going to mention his name. He can reveal himself if he wants to. And I'll retweet out his. Go to his Twitter account. I spoke to him this morning. He's up in the Boston area. We know a lot of the same people. I think he told me he got 250,000 hits. I'll let him tell the story. But he put out this incredible thread the other day. He was channeling his inner George Noble, Donkey on Kathy Woods after and I was like, I got to talk to this guy. So I looked him up. I DM'd him. We connected. We're soul brothers. He's my new best friend. So Mr. Flowpoint, welcome to the stage. The floor is yours. Feel free to talk about whatever you want. You want to identify yourself. You don't want to identify. It doesn't matter. I'm sure everyone is keen to hear. Why did you put up what you did on Twitter the other day? And maybe you could sort of build out those thoughts a little bit. Thank you.
Well, thank you very much, George, for having me on. I appreciate this. I'm not sure that this is the smartest thing you've ever done. My kids would be appalled that somebody has given me access to an open microphone without any governor on it. The tweet itself was in response to, and look, my views are in alignment with just about everybody that's been on this call, which was what was prompting my frustration. And I had just come from a small conference that I had done at the request of a friend who's an RIA. It was basically a prospecting session for him. And he was talking to a family office allocator, and we run nothing but private funds. And we do that, for reasons I can get into later in this broadcast. But we were talking about why we focus on the private asset classes and the benefits to private asset classes. And the comment that I basically got back from him was the stuff that we do is too risky. And this is a guy whose second largest position, according to Bloomberg, is ARK Innovation Fund. So how the hell can you own ARK Innovation knowing how she manages money and knowing how she's distributing the risk across her portfolio, and knowing what everybody knows about her portfolio construction techniques? How can you tell me that private asset classes are risky in comparison? And I was sitting in a bar after with a couple of my partners having dinner, and I basically banged that tweet out, sitting at on a bar napkin almost, in frustration, because it was just like, these people with the not invented here syndrome, which afflicts most of the RIA community. But then you talk to their clients, who are very, very, very well-heeled people and smart, and nobody pays attention to the stuff that we've been discussing in this room. There's just zero concern about portfolio construction and where your risks are in your own portfolios. I mean, what prompted everything, and I listening to Albert, it's coincidental that you had me on, because the purpose of me going to this conference to talk to these RIAs and these other clients at the request of a buddy of mine was that I had sent him a note saying, look, 73 stocks in the S&P 500 are trading above 10 times revenues. That's just insane. So when Albert came on talking about, EV to sales ratios, I was laughing to myself listening. I mean, that's what prompted this conversation, and that's how we got into the discussion about Kathy and, why we're trying to do things differently away from the public markets. You just look at the performance of the stocks that are trading at these stupidly high multiples. And this was back in January when I sent my buddy this note. You look at their performance just in the month of January, they were getting obliterated. Yet these guys that I was talking to that were telling me that my private portfolio of private assets is way too risky, they own all these stocks that are trading at 10 times revenues. I mean, so how do you explain that? Right. So that's what prompted the tweet.
So that's phenomenal. Could you, if you want me to read it, fine. I don't know if you want to read it verbatim, but just for those that are in the room that didn't read the tweet, it might be useful to hear you read it out in your own words. I mean, editorialize as you wish, but I think it'd be really helpful for those that haven't heard it, because many of us have, but many in the room haven't. So would you mind reciting, or if you want, I will do it with however you'd like to proceed.
Yeah, you know what? You're probably better at this. I'm afraid I'm going to kick myself off your space if I do something stupid on my phone. So,
all right, hold on one second. Let me just find it here. And so, hey, hold on. So, where are we here? So, bear with me. It was okay. So this was, just for all you know, this was in response to Kathy Wood's appearance at the ETF conference in Miami on Thursday, I believe it was, Wednesday or Thursday. And she did a CNBC interview with Bob Pisani. And we went nuts that night with our own space. It was epic. Everyone should go listen to the replay. It's on YouTube if they're interested. And you coincidentally around the same time, you tweeted out, there's this wonderful thing where, the whole thing where Kathy was claiming her portfolio is going up 50% a year for the next 5 years. So you had one tweet here where you said, remember when every word of every presentation you made publicly had to be run past compliance? and how you could never discuss performance anywhere unless the statements was followed by 52 pages of disclosures. I mean, that is so spot on. The outrage. I mean, I worked at Fidelity. You worked at a big firm. You can't go to the bathroom without compliance, double checking. All right. And that she gets up and says this stuff, whether it's illegal, which it may be, or it should be illegal, it's the sort of stuff that no person of good character, of any responsible nature, no one would ever say this stuff. So let me just now go to your tweet storm. I've spent the past few weeks in the depressing company of high net worth investors, and I'll interview in a couple of these points here. In the depressing company of high net worth investors, the experience has been sobering, alarming, comedic, maddening, frustrating, and ultimately cathartic. Here's my summary conclusions. 1. Outfits like CNBC are doing untold damage because they feed a hype cycle that will ultimately prove to be disastrous for retail investors. 2, retail only cares about performance and can brag about cocktail parties. Let's just stop for 1 second. What is your take on CNBC and their complicity in their role in this whole disaster?
I think they all ought to be ashamed of themselves. I scratch my head when I think about Henry Blodgett, who I'm no fan of, taking it on the chin back in the 2000s, and yet they get away with what they get away with, and Jim Cramer gets away with what he gets away with. And why was Blodgett drummed out of the industry, yet these idiots have a microphone? I mean, it's just irresponsible.
Yeah, and I think part of the issue too is maybe you could reflect, because you've been around for a while. You're reflecting the changing nature of the industry. At least back then, we didn't have social media, so when someone had a microphone, they were working at a big firm or something like that, and they would be subject to the compliance dictates that were existing at the time. You don't have that now. You have people talking crap, and the problem is it's monkey see, monkey do. This is the phrase I used the other day. When one of them does it, they all do it. So what happens? Elon Musk comes out with these bullshit things about orders and backlogs, and he's just making it up, and it's been proven subsequently that it was all wrong, was all false. But leave that aside, he gets away with it. So guess what? Elon Musk has a child. His name is Trevor Milton, and Nikolai does the same exact thing. And then you have that jackass at Lordstown Motors, same thing. Okay, there's been complete regulatory failure here, complete lawlessness. And so the regulatory regime has totally changed. And so I guess there's a question there somewhere. I mean, don't you think, when you think about the rise of social media and the fact that the regulators have gone completely MIA, would that help give part of the answer why Blodgett took it on the chin and these charlatans get away with it?
Well, yeah, but back then Congress got involved, and there was it was more of a populist, protect the little guy kind of environment. Well, one of the points that I didn't make in that Twitter thread was, this environment, you don't hear from Elizabeth Warren because nobody's gotten hurt yet. We haven't had the big correction, and you haven't had the the WorldCom that takes everybody down with it. So,
right.
I'm just waiting for that.
It's a great point you make, and you remind me of that, because Jim Chanos, who I'm friends with, he was in this room 3 weeks ago. You all should go to my YouTube channel. We put them all up there. And by the way, I have to put in the good word again for Carol, Andrew, Jack, and RJ. This wouldn't be possible without them. They put up all the recordings of our sessions, our spaces the last few weeks. And Chanos is in there talking about how, like, there's the hype cycle, which precedes, like, the regulatory crackdown cycle. It's only when someone gets hurt. You just hit the nail on the head. They don't want to be seen to upsetting the party. They wait till a crime's been committed, and then they come in after the fact. They're never in front of it. They're always behind it. And so, and then what I'm worried about is this has gone on. It's just so much. Don't you think this is not just the hype cycle, but the excesses are just so much worse than 2000? I mean, it's complete and utter lawlessness.
Yeah, that's been the big change between 2000 and now. Is the regulators have just completely abdicated, and I'm just shocked at the things that you see now in print. I mean, George, you have to submit your entire speech to compliance, where they would go over it word for word on what you're going to talk about. And yet, she's out there popping off about 50% compounded annual returns. It's just nonsense. And what Musk gets away with on a daily basis is ridiculous. What I was laughing at earlier when you were going through Lordstown and Nikola. It's funny that Kathy owns all those three. Tesla, Nikola, and Lordstown. Anyway, I want to get back to that tweet thread, and then we can move on to something else, or you can get rid of me altogether. But the guy that I was talking to was the chief investment officer. What prompted my frustration was I was talking to the chief investment officer of a really large family office, and the guy was maybe early 30s. I don't think he'd been in the markets in 2008. So, you're probably close to my age. So we've lived through what? The Russian currency devaluation, the 2000 meltdown, 2008, the Asian currency crisis, you name it. I don't think this guy was in the market prior to 2008 and with zero perspective, and is like aggravated when his managers aren't doing 20+% annualized returns. What are you, out of your mind? You know how hard that is over a long market cycle to do 20% a year? And he's like poo-pooing and making fun of all the managers in his lineup that he's going to fire because they didn't have Kathy-ish returns. Well, how'd you do with Kathy last year, bro?
It's funny you say that. I will tell a couple stories that I've told in the past. Jeremy Grantham, who's been around a long time, who whenever he's in a room, he is the smartest guy in the room. He's been, wrong or whatever early. I mean, he's been caught out by the bubble like a lot of us older, longer-term investors have been. But he's really smart. And I remember him telling, I apologize for those who heard this story before, but he got up, it was at a grants conference in like 2004, 2005, and told the story how in 1999, 99 or 2000, somewhere around then, somewhere near the peak of tech, Grantham Mayo had a rough go in the late 90s. They didn't lose money, but they weren't drinking the Kool-Aid, and they started losing assets like crazy. The CIO of the GM investment office wrote a memorandum circulated internally where Jeremy Grantham was banned from setting foot in the GM investment office on the grounds that he was deemed to be a dangerously persuasive person. He wrote really well, he communicated really well, and he's costing people money because he was preventing them from buying tech stocks. You shouldn't listen to him. Well, we all know how that worked out. I think their assets went from 18 billion to 140 billion in the ensuing years. In recent years, GMO has given up on active management. I think they're largely indexed, and they've had a rough go. But my take on that is that tells you more where we are in the cycle, because sometimes the market makes you look smarter than you really are, sometimes dumber than you really are. And the fact that people are ridiculing Jeremy Grantham, to me, tells me where we are. In similar fashion, you go back to the tech peak, and I want you to weigh in on this. Do remember that Stan Druckenmiller, he got taken out. He drank the Kool-Aid. He got sucked in at the top and got blown up. George Vanderheiden, the best fund manager you've never heard of, Peter Lynch's number 2 at Fidelity, he basically got fired because he wouldn't own tech. Chuck Cloud, who was Rich Bernstein's predecessor at Merrill Lynch, great guy, runs Cloud Capital now in Boston. He basically got run out of Merrill Lynch because he couldn't buy tech. And then this is seared in my mind. People can remember where they were when certain things happened, or certain people said certain things. I remember, I'll find it and I'll tweet it out. There was a quote from somebody at Warburg Pincus, like private equity or whatever. This was like February of 2000, and the exact quote was, the money line was, "If it's not tech, it's Drek. If it's not tech, it's Drek." And back then, we didn't have Kathy Wood. We instead had Garrett von Wagoner, Alberto Villar, who wound up going to jail actually for embezzlement, Henry Blodgett, Ryan Munder of the NetNet Fund, Kevin Landis of the First Hand Funds. You remember all these names, okay? So the song remains the same. We've seen this movie before with different subtitles. So again, to me, what's so awful this time is the out and out lawlessness. And I think Twitter and places like this, I got in a dust up this morning, not a dust up. Someone tweeted out yesterday, and KFAB, I want you to weigh in on this, and we'll have Mr. Flowpoint talk some more. But KFAB, I want you to speak to this. There is an energy fund manager, all right, who has been, I'm going to choose my words carefully here, who has been known to misrepresent things, who actually lies about things. I'll say that. If he wants to look in court, that's fine. He misrepresents things, he lies things, he defames people. And everyone's been running around in full point. This is a question here, but I want to contextualize the question so you understand where I'm coming from. Everyone thinks this guy's a fucking genius because he's up 380% last year, whatever he was up. In KFAB, maybe you could speak first, and then full point will speak again. And so I mean, I'm sure he's a smart guy. I don't know. I just know the way he's defamed certain people and lied. He's not my cup of tea. And so someone tweets out the guy's performance record. And, you know, as a hedge fund manager, you cannot advertise your performance. Well, somebody else put out his performance. Okay, fine. It didn't come from him, but for sure he gave it to this other guy who shouldn't have tweeted it out because it's private information. So this guy tweets it out, and he's up like 380% last year. But now the truth comes out. You know, you take a look at the prior 4 years, it was an unmitigated disaster. This guy got down to, I think, 8 million under management. There's a reason now, even being up 380%, he's only managing 40 million because he's a laughing stock. You take one look at it in KFAB, I want you to weigh in on this. You take a look, the guy's down like 40%, 50%, 60%. I think he lost his biggest client at one point. He got down to $8 million. Good for him that he made money last year. I'm happy for him. But here's the outrage. Here's the outrage. He's running around talking about his 380%. He, up until now, the fact's been hidden that he's been unmitigated disaster. I think from peak to trough, he was down 70%. So when you're up 380%, it barely gets you back to break even. Don't hold me to it exactly. He's doing well now. Good for him. But he hit his record completely. And here's the worst part. You say, well, that's okay, George. You're not supposed to. Here's the worst part. You look at his marketing document. He has a performance by years. And you can find it. It's out on the internet. Just look up Cuppy's feed. It's in there. And you look at, he has the temerity to say, to start counting performance at one point from the low of like March of 2020. And it's like, look at me. I'm up 380%. Or, you know, if you had invested $1 million with me on March of 2020, you'd have $4 million. And KFAB rightly points out, wait a second, dude. You didn't give your 3-year trailing return. You didn't give your 5-year trailing return. Oh, and by the way, you're running a small cap energy fund. And you want to use the XOP as a benchmark, which is a large cap index. Like, that is so fucking wrong, if not illegal. I know Fidelity Compliance would never let that fly. I know any legitimate hedge fund that's got compliance issues would not let that fly. All right, but here's the problem. Here is the problem. In the sewer that is Twitter, where you have uneducated individual investors who don't understand how the rules work, they get sucked in by this crap. And so I tweeted this out just I actually liked KFAB saying I responded to it. I tweeted out, and you got some fucking ignorant retail investors throwing shade at me. I'm like, are you fucking kidding me? KFAB, you want to weigh in on this?
Yeah, just on the narrow point of the actual marketing document. So again, I've personally overseen an initial GIPS verification, been involved with a software vendor that does GIPS compositing. So I have a pretty decent handle on these kinds of reporting and the associated compliance that goes along with it. You know, I launched a 40 Act fund back in the day myself and managed it. So, you know, I have a decent domain experience, and the nature of that report is just unacceptable to the point where, I mean, if anyone is an adult in the room that has any compliance background, they just wouldn't let it happen. And again, I'll take the more charitable route, George, just because I'm a more diplomatic person probably than you are. You know, if I take the best assumption, they're a real small firm. It seems they only have 40 million in assets under management, and small firms outside bootstrapped up. Sometimes it's ignorance; they don't know what they're doing. But I mean, to go to public with that and distribute it in the public domain is really just not good. And it goes back to this idea. I mean, you know, regulators just don't. They can't be everywhere at all times, and it is the Wild West. I mean, this is the golden era of fraud, as I think Jim Chanos would say, and you know, the stuff that they do go enforcement at, you know, they basically take the low-hanging fruit of small people, small firms, and let the bigger companies just get away with absolute murder.
Yeah,
so
it's a KFAB, but I'm just going to push back because you and I are 90% in agreement. And yes, you are more diplomatic than I. You're not the asshole that I am. But that guy has had institutional money before. He knows the drill. He knows.
Yeah, fair enough. I don't know him. I don't know the
No,
firm.
I know him. He knows the drill. I also know the lies that he's committed in other public spaces and the defamation, and I know how insecure he is. And he's welcome to come in this room if he wants to, but he won't. And so this is the sort of thing, and this is the regulatory failure. Anyone who understands best practices and what you're supposed to do, like you wouldn't even dream of doing that because you don't want the SEC in your office. And I promise you, if the SEC came in your office and you did that, you'd be dead to rights. You know that, okay? But this guy pulls this stunt because he's got no moral compass. And by the way, if anyone thinks I'm being a bit harsh, please, you know, I'm happy to debate the facts, and there's nothing factually incorrect about what I said. I will tell you, because I've been in, multi-billion-dollar operations, that alone, the fact that somebody was thinking about that, put stuff out like that, forget about it's right or it's wrong. It is wrong. It goes to motive. Like you would run, not walk, as fast as you can away from anybody whose moral compass is so broken that they think that's an appropriate thing to do. We're all brought up. And I guess I'm really on a rant now. We were all brought up. I suspect most of us. You do things because you're told it's the right thing to do. Not can I get away with it? All right. And there are too many assholes on Wall Street. Not just the guy who did this, but I could go. Chamath. You could just go down the list. Kathy Woods. Elon Musk, Lordstown Motor, Nikolai, et cetera, et cetera, et cetera. Okay, they pull this stuff, these stunts, because they can get away with it. And I'm saddened to say, going back to Flow Point, he's right. This might likely not change until we get the car crash. But I mean, I'm calling this guy out. This is just outrageous. I'm sure he's going to listen to. I'm sure he's going to listen to this replay. Come on, bring it. Get your ass in here. All right.
Yeah, if I can make one more point, George. I mean, again, I don't know the firm, I don't know the guy, but the red flag for me, another one is any kind of serious institutional asset owner is going to look at that report and see the problems, as well as vomit all over themselves with the volatility profile. So whether it's a pension fund, a family office, an endowment, whatever. I mean, that is not a marketing sheet that's going to attract their attention in a favorable way. So then you have to question, okay, well, who is it targeting? Again, or is it being targeted in a very incompetent way towards that for potential investors, or is it being tailored in a way that's trying to attract money from lesser sophisticated, high net worth type of people, that kind of thing. So that's the other thing that struck me.
I appreciate the KFAB. All right, so I got to go take my meds now, but I spoke my piece. So, Flow Point, maybe just speak. I mean, we'll go back to your Twitter. So I'm sure there were some things you wanted to say here. We'll get back to your tweet from the other day. But thoughts, comments, reactions to anything we've been discussing here?
No, I'm in agreement with just about everybody. It's kind of disappointing that Morgan Stanley is Kathy's largest shareholder. God knows how Morgan Stanley's justifying that position. I'd love to hear what they say. I mean, think about it for a second, George. What would we have to pay to get on Morgan Stanley's platform with products back in the day? $250,000 just to get access to the platform. Then you have to go through a 3-year screening process where they go through all kinds of diligence. They examine your record, and yet they're pushing ARK funds. So where's the diligence? That's the disconnect that bothers me the most. Yeah, there's a breakdown from the regulators. There's a breakdown from people on the allocator side that ought to know better that don't. But I mean, what's Morgan Stanley doing?
100%. All right, let's go back to your thread. So you were saying retail only cares about performance and can brag about at cocktail parties. Okay, here we go. Then 3, because of 2 above, you are almost rooting for these morons to have their lunch handed to them. And when the lunch gets handed to them, I, for one, will be deliriously happy because they absolutely deserve everything coming their way. I mean, dude, I so applaud. I'm totally with you. You and I are new best friends. Then you write, just this week. Okay, now you got to explain. This is the money. This is the money. This is the one in your thread that got the most likes. It got 666 likes. So I want you to spend time in this. Just this week, a high net worth investor who brags about his investment acumen said this to me. I check Kathy Wood's market commentary every day, and she thinks ... Kathy Wood is your portfolio construction resource? I want to shoot myself in the face. I mean, seriously, Kathy Wood, the one who is, calling Miss Whale Oil Queen, oil's going to $12. Oil consumption peaked in 2019. It's never going to exceed that again. Oh, by the way, now she too is a yield curve expert. All right. It's transitory. Okay, so I mean, seriously, Mr. Flowpoint, was this guy with a straight face? Was he just being tongue in cheek, or was he serious when he goes, I rely on Kathy Wood's commentary every day? Was he being serious?
CIO of a major firm with $600 million plus in assets. She's probably mid-30s, and ARK is one of his biggest holdings. So yeah, I would assume that he was dead serious, and that's the alarming fact that this guy's got responsibility over client portfolio construction, and ARK's his second biggest position.
You can't make this stuff up. I mean,
no, really can't.
You can't. All right, let me keep going. I want to hear about this guy. So talk about this guy. Another investor showed me his portfolio. Tesla options. Hey, Albert, I hope you're listening. Tesla options, GME, AMC, NIO. These options are great. The returns are too good to pass up because they only go one way. He told me he got involved in AMC because everyone he knew was talking about it. Way to go, SEC. Was this guy like some crazy, or is this another guy with a lot of money? Like, who is this guy?
He was one of the RAAs, the CIO that got ARK as his second biggest positions. He was one of their clients, and he was at this conference, and he was just showing me what he's got away from the RIA. We were having a sidebar conversation, and he was showing me this portfolio, and I'm like, "You got to be kidding me!" I mean, how? I didn't even know what to say. I mean, so we got into a conversation about options. And I started to talk to him about the whole gamma squeeze thing in Tesla. And he had no idea what I was talking about. And he didn't know who Bill Huang was.
That's amazing.
So how can you make this one of your largest positions and not understand the backdrop? I'm looking at the guy. I couldn't get out of that room fast enough.
Wow. So just hold it there, Flowpoint. So Albert, are you still there? Albert, are you still there?
Yeah, I'm here.
Yeah, well, I mean, I don't know if you're pouring yourself a stiff drink or whatever. Are you just want to like shoot yourself? Like, what's your reaction to everything Flowpoint is saying? This is insane.
Look, it reminds me of Blodgett in 2000. It's exactly the same story, except one is running money and the other one was a broker. But it's so similar.
It's just,
George,
they're basically the great the stock promoters, but it's a great marketing story, but I don't know if she knows what she's I listened to her YouTube channel once. She puts up a video every week or something, and actually, I mean, she has like two words, like innovation is great. Innovation is going up.
Albert. No. Albert, you got to practice. Say after me. Repeat after me, Albert, slowly. Innovation solves problems. Innovation solves problems.
Okay. And then she spends 45 minutes on the yield curve and economic stuff that she she obviously knows nothing about, and then 15 minutes on the companies that she knows nothing about, and she talks about her analysts who are the greatest in the world and blah blah blah. I mean, it's ridiculous. But the most interesting thing, I don't know who talked about that, is she's getting inflows. So the NAV is going down all the time, but actually the funds under management, I mean, the funds under management probably must be down because of the stock prices, but she gets inflows.
100%. So actually, I see Bob Klein has stepped into the room. Bob's been around; he's seen cycles, and I'm sure he's got an opinion about this. So Bob, what say you, Bob?
I couldn't resist stepping in here, George. Hearing stories, really, you've got an environment where investors are stoned. It's like going into a room with people on acid, and they've never been in one. Really?
Wait, Bob! I gotta tweet that out. It's like going into a room with people on acid. Was that the quote?
That's what's happening. You walk around, the Cappy Woods of the world, and the people that were being described by Flowpoint. It's just it makes you crazy, and you want to shake them. It's like the lunatics are running the asylum, and this happens every every boom, every speculative boom, of course, as you guys know. But the real arsonist here is the Fed. The Fed has more than doubled the money supply over the past couple of years, just in terms of the most liquid money, cash, checkable deposits. So most liquid funds have doubled. So what can you expect to happen? You're going to have a raucous bull market, and the people, the dumbest kind of stupid investors look smart, as you. I'm preaching to the choir. I know you guys well know this, but that's what's going on here, and it's just, you just want to shake, it's so maddening to watch these idiots succeed, for the short time that they do, and it's going to end, but it takes longer than you expect. And you look at Cathie Wood's inflows, and you just scratch your head and you say, what are people thinking? And I didn't know that about Morgan Stanley. That's interesting that they're shilling for her and pushing her. That explains some of the persistent inflows. But I just great to talk to all of you, because I'm out here in California, Southern California, and the people I talk to or the people like Flowpoint talks to, and it's pretty maddening. So it's a sanity check to be on your calls, George. I appreciate everything you're doing.
Appreciate it. Well, let me bring Robert into the conversation. Robert, you got something you want to add? Robert?
Yeah, thanks for having me. I just wanted to point out a fun fact that I heard someone say the other day about Cathie. So she upped her target to 50% annualized, right? And in January it was 40%, but her funds are down like 50%. So she's actually been getting more bearish if you do the math. Anyway.
Did you see the detail behind? Did you see the detail behind that model? Though she's expecting them to do 10 million car sales in 2026. 10 million.
Yeah, I mean, all of this is ridiculous, but I just thought it was funny that, with her funds down 50% since January, she should have actually said like 60 or 70% annualized returns. But I guess maybe even she is getting a little bearish. I just wanted to ask one question to Albert. Getting a little bit off topic, if that's okay, going back to his presentation earlier.
Go for it. Go for it. Yep.
So I was wondering, so you're expecting yields to rise, and real yields have been rising very sharply recently, but you're also bullish on gold, which I am too. I was wondering how you square those two, because there has been quite a disconnect in the last few weeks between real yields and gold. And my kind of thesis in how this is going to work out is that bonds are very oversold right now. I think we might get a short-term rip in bonds, and that's going to be the catalyst with real yields going down. That could be the catalyst for gold and gold stocks really going up the next move higher. I'd love to hear your take on that.
All right. I mean, if you look at the the price of gold and interest rates, over very long periods of time, you will see that interest rates. I mean, that interest rates, gold can go up in different type of interest rate environment. So if we are in an environment like the 70s, for example, like between 1975 and 1981, 1982, when Paul Volcker came in. So interest rates went up, to the moon, and gold prices, were going to the moon as well. So, I don't think it's it doesn't have to be exclusive, that gold. I mean, interest rates go up and gold might not go up. I think it's not that important, actually.
So Albert, let me ask the question a slightly different way. So obviously, if all hell breaks loose and the economy's going into recession, they're going to get the printing presses out, money go burr, on the road to Weimar. Okay, I get that. That's the way gold works. But let's say we're in a world where just inflation is the idea, though, that if we're just sort of in a slow growth world, but without recession, without the Fed having to print more money, is it just the idea that real rates will stay negative and maybe the market starts to see that more, and that's why they'll bid up the price of precious metals. I mean, without the Fed expanding its balance sheet, because again, there's correlations come and go, but I think the question has to do with, people show this correlation, spurious perhaps, but they show the Fed balance sheet against the gold price or against the stock market, blah blah blah. They show real rates. So the idea that if the Fed doesn't expand its balance sheet, how do you is it more the idea that gold is sort of anti-financial asset? Like, what's the narrative that you would put with why gold would go up even in
Yeah,
the world? Yeah, so what would your rationale be?
I think that's what it is. It's the new version of Tina. It's like there's only one alternative, and that's gold. I view it like that.
Right.
Look, I mean, I mean, I think I mean, I think if you think about it, I think I mean, inflation is actually here to stay and to stay for quite some time, and to be elevated. Again, you've got this commodity stuff, you got defense spending, you have the climate change, which is going to bring more spending and more supply problems for commodities and so on. So I mean, there's basically a wall of money, which I mean they have to depreciate. The currencies. Governments are going to have to spend more and more money, go into more and more deficits and stuff like that. And it seems like currencies are going to be it's the old story, but it looks like currencies are going to be debased.
Yes, no, I think you're.
And
you're
then if you want the catastrophic scenario, but which has some way to go, I think this Ukraine Russia stuff, I think could be very, very serious, and there are people writing about it, but there is a de-dollarization process going on. Okay, so like it's the wet dreams of the Russians and the Chinese, to have the US, the US dollar losing its reserve status, and it might not lose its reserve status, but it may lose its prominent status as a reserve currency.
100%.
So if the Russians starts to buy stuff from India for rupee, and India buys oil for ruble, I mean they're talking about that, and it's some kind of a form of barter. And the Chinese are buying, the Chinese are talking about buying oil from Saudi Arabia in yuan. It seems like there could be a drive to make the dollar a lot less important as it is right now.
100%.
And if that happens, I mean, if this happens, then I think gold is going to go berserk.
Right. That's great. That's great. All right. So stay there, Albert. We got more questions coming for you. Just want to update everybody. We're picking up some steam here. This was some very generous contributions. We've raised, I think, $1,500 so far in the last 45 minutes, which is awesome. So again, if you're getting value from these spaces, please give generously to World Central Kitchen. Sohei put the link up at the top. We're dealing with first world problems here. There are people out there who really need us, and if you've gotten value from these spaces, please give generously. All right, so Flowpoint, it's back to you now. So we're about halfway through your thread. This is great. So okay, so we will just pick up where we left off. So you had this other guy who was bragging to you about his Tesla options and his AMC and his GameStop. Okay, so then you go, I asked him to identify the risks in AMC's business. What do you mean, was the response? With a straight face. I went through comps with him, a basic balance sheet, and cash flow projection. Got the dead trout look. Like Flowpoint. Was it like this dude had no clue what you're talking about, or he just didn't want to deal with it? He was in denial. Like how could someone in a position of financial responsibility, a fiduciary, not give you a thoughtful response? Like what was this guy's deal?
You will look at their balance sheet and their cash flow statement, and Cubico has done a really good job just outlining the cash flow issues that AMC faces, the declines at the top line, and how that filters down through the rest of the P&L. This guy had no idea what kind of a precarious position AMC was in from a cash flow standpoint, from an operations standpoint. None, zero. He believes in Adam Aaron's nonsense that they're going to turn it around and there's going to be this influx of new customers and that's going to change everything at the top line and popcorn and whatever the hell else he believes. He's just buying into the nonsense that Aaron is spewing, and he's never put pen to paper and actually looked at what AMC looks like on an operating basis. He just didn't seem to care. I don't know, maybe these guys are playing a game of musical chairs and maybe they think they're going to trade themselves out of it, but look at AMC's chart. The stock's down 50%.
I know, and you know what's amazing too? I mean, I've gone on the weeds at AMC like you have. Aaron is selling, and the insiders are selling every single share of stock they could possibly sell as soon as they get their hands on them when the options vest. It's unfreaking believable. And by the way, I once went to an AMC APRM. Never again. These people, they're in this sort of dystopian parallel universe. I mean, it's just unbelievable. You can't. None of them do any work. None of them do any of the numbers. They don't know what they're talking about. All right, let's move on. So then you write in number 7. Not a one of these high net worth nitwits knew what a gamma squeeze was. Some had never even heard of it. Not one knew who Bill Wang was or what the average annualized return of stocks has been since 1999. Zero perspective. Like, Flow Point, were you on drugs when you were writing this?
No, definitely not. Definitely not.
Portfolio construction, taking gains, selling early, discipline exits were all concepts utterly alien to these people. I looked at one guy's portfolio and asked, why do you own so many consumer names? The answer was, why does that matter? They're just stocks. Could you imagine, like, back in the day, I mean, when you worked at a bigger firm or whatever, or just where you are now with your partners, could you imagine going into a meeting with responsible financial people and, like, if you heard somebody say stuff like this, you would, like, call for the cops. Like, this is unbelievable.
Okay, you'd be surprised at how many RIAs have no idea what the unintended tilts look like in their portfolios. They have no idea. They haven't done kind of a top down.
So they don't know anything about factors and all that kind of stuff.
No, factor investing. I didn't even want to get into factor investing with these guys because God knows where that would have taken us.
Oh yeah. All right, let's keep going here. We're going to wrap this thread up anyway. I don't mean to demean the thoughtful individual investor, but actually you're too nice a guy. I would have meant to demean. I probably would put his name out there because some do exist, but I've been utterly shocked at how disproportionately skewed my sample set has been because the idiots outnumber the thoughtful by 10-1. Again, the lunatics are running the asylum. The driving force for all of them was greed. Absolutely no regard for anything else except for how much money they have made. Sell-offs are nothing but buy the dip opportunities created by the weak knees. And finally, so when this ends in tears, I will very quietly sit there and watch CNBC hang all crepe and smile. They deserve it all. I mean, doesn't there seem to be this holy alliance from, the shyster promoters, the Elon Musks of the world, to the enablers, the CNBC crowd, the John Nigerians, Price is Truth idiots, to the the individual investor. It's just greed. I mean, it's just the whole food chain. And what I wonder about Flow Point, there's a question here. Like, until this, we know this is going to end in tears, but really, I don't see any other way that these guys are going to get the memo because it's like the dream lives. It's like they just don't get it. I mean, so you think just that in a bear market, as Andrew Smithers once said, the role of a bear market is to return capital to its rightful owners. And I fear the same is true here right now. So to me, I think it's inevitable. These guys are all going to get destroyed. What do you think?
I kind of want them to get destroyed, but I want there to be a different response to it this time. I mean, the last time people got destroyed, we got Dodd-Frank and then we got Sarbanes-Oxley, two of the worst pieces of legislation ever to come out of Washington, D.C. Just utterly useless, not even close to accomplishing what they were meant to accomplish. So when WorldCom took out hundreds of thousands of individual investors and all the populists started popping up, this time I don't want to hear from Elizabeth Warren. Just sit down. These people know exactly what they're doing. They're gambling the way they want to gamble. Let them gamble. And when it unwinds and they all lose it all and they're on bread lines, too bad. Let it go. No more new legislation. They should have learned their lesson their last time. They didn't. Let it go. I don't want to hear from you.
It's just outrageous. All right. Amy. Hello, Amy. How are you?
Hello, sir. You know that I've been pretty outspoken about the AMC stuff, so I just wanted to tell you. I think I know why. Or this is why the insiders are selling so much. They made a they voted on a comp plan in 2020 that says that they were going to give up their salaries and bonuses in exchange for shares that could not vest unless the stock price doubled or tripled. So I think what happened is they took that, they voted that in, they got their shares. Everything we've seen since is probably responsible for the price, and those shares started to vest in 21, which is, a year later they started to vest, and that's why they're dumping them, because the share price was, they've been dumping since, 50, 40, 30, all the way down. So, and then the other ones will continue to vest as long as the share price stays doubled or tripled from when the comp plan went into effect.
Wow. So the float is going up enormously.
Yeah.
And the valuation is still insane. I don't know. Amy, where do you think the stock go? On a fundamental basis, is this thing worth anything? Like, what do you think on a fundamental basis? What is it worth, Amy?
Fundamentally, if they stay on the track that they're on right now, which I don't think they are, if you check the box office numbers quarter by quarter, I know quarter one is pretty tragic, but they do have a bunch of big movies coming out. There is a very large crowd, promoting it. So if they stay on the track they're on right now, I think fundamentally it's a $5 to $7 stock.
Right. And are you saying though in the short run there'll be some big hits coming out, so they may have some better numbers for a short while?
I think so. I think that you can't deny the fire behind the quote unquote ape movement. So I think that there are people who are subscribed wholly to the buy and hold, which is why I think the stock stays pinned between $13 and $20. It has a run up whenever the shorts cover, which I think that's what we saw on that
right.
Burst up to 34 and then it dropped down. But so I think it's going to stay pinned for that's what about the range for the buy and hold crowd, right? The ones that are not selling. But I think it's ludicrous to think that some people retail within that movement aren't selling. They're losing patience. They're selling. They're moving on. They're seeing other people make money on other plays, and then they're putting their money in those plays. So, I think there's some shifting going around, but there is, I think, a range of those buy and holders who keep it elevated.
George,
go ahead.
I'd like to add something on AMC. The narrative that management is pushing, and it's really travesty, is that, look, we're this poor old company. We just got blindsided by the pandemic, and it's, as Adam Aaron says, it was breathtaking, our moves that we need to survive, blah, 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 blah. That's the narrative, but the truth is very different. This company borrowed over $2 billion to buy 3 movie chain companies from 2015 to 2017. So they buried themselves in debt, expanding right in the throat of the boom in streaming. And here comes Adam Aaron buying up three movie chains, borrowing money to do it. And he made his own bed. He literally almost destroyed the company, as then the pandemic hit, of course, and then streaming really took hold, and he got bailed out by the Fed. If the Fed hadn't done what they had done, he would have gone bankrupt. And yet the story is very different. The story is this glowing Messiah story that we keep hearing from him, his constant tweets, and I can't take the conference calls. They're just lavishly praising himself and droning on and on about what a miracle he's created and going to create in the future. So this is just run by people that don't deserve what they got, and it's a travesty, the bill of goods that they're selling the world, and unfortunately the press is lapping it up. The Jim Cramers of the world are lapping it up, and it's more nonsense.
Well, again, we're in this post-truth society where nobody does any work. They just get their, as you say, they just they get their information from Jim Cramer or CNBC or God knows what. And the truth becomes what people say it is. And so whether it's Elon Musk making shit up about reservation lists, or it's Adam Aaron, or it's it's all the same. It's all the same thing. And they're getting away with this because none of these companies have to justify themselves in terms of fundamental performance. I mean, think about what's an asset worth. It's worth a lot of things, but it could be what the last person is willing to pay for it. It could be a multiple of cash flow or book value. It could be any one of a number of things. And right now, there's just too much freaking money in the system, and so all these things are floating along on a sea of liquidity. And when the tide goes out, as it is, prices will converge to a more fundamental valuation. So I think all this crap is just going to get completely destroyed. Amy, I see your hands back up. Your floor is
Yeah, I
yours.
just wanted to respond to Bob. So, I think that goes back to the comp plan that I was talking about in 2020. So if you look at the timeline, theaters stayed closed through 2020, and they made that change in February of 2020. So they had all just gotten shares, right, that were based on the stock price doubling and tripling, but then theaters stayed closed. So I think the right path for the company would have been for him to declare bankruptcy, retire the debt, but then they would have had to give up their equity. So instead, they took very toxic financing, took on $6 or $7 billion worth of debt, and thought they would just climb out. But I think that has a lot to do with the fact that in February of 2020, they all got a lot of shares, and
Right.
they weren't giving up their equity, especially not Adam Aaron. I mean, he's taken home, $60 million in 21.
It's outrageous.
And they all of a sudden they all were on the 105B or 10, what is it, 10B51? I can't remember what it is, but they were all on that plan, right? So that they could start selling off these shares that vested because the share price escalated.
I mean, Amy, Amy, I'm just going to mute you because there's some background noise here, which when you're not talking. So 100%, and whether this is legal, illegal, or it should be illegal, doesn't matter. We would all say it's wrong. So, whether you say, well, they could do this whether they didn't break any laws and the laws are wrong. I mean, everyone's just trying to freaking game the system. So before we continue this conversation, I just want to say I'm very grateful to all of you for pitching in. I've seen we've had about 14, 15 people throw a few bucks in the till here in the last hour. Gary Armstrong, Richard Hughes, Armand DePaul, Greg Coate, Dang99, Todd Lally, Trader Lowe, Elizabeth Wang, a couple of anonymous was, Jayesh Gupta, Terry Peterson, Peter DiCaprio, Brian Humphreys, and Dennis Rogenius. So thanks to all of you. And again, if you're getting any value from this room, please, please, please give to World Central Kitchen. They are truly doing God's work. So stay there, Amy. I want to hear more from you, but I want to bring some others in the conversation I haven't spoken yet. My good friend Bobby J, what's on your mind, Bobby J?
Yeah, one thing that we don't talk about is if we are heading into an environment with a 3.5-4% 10-year note, a widening of high yield spreads because of a higher VIX, do you want to own a portfolio of equities that have an average rating of Ba2 or junk? And if you look at Kathy Wood's portfolio, that's something that I don't hear. And what's the real reason? What do they have in common? Tesla, BA1, Twilio, BA3, Block, BA2, Coinbase, BA2. So is the real reason behind the performance of this portfolio, the one thing they have in common across is that they either don't have a credit rating or they're below investment grade. And I'll leave you with that.
So Bobby J, brilliant insight. No, Amy, let me take this. So first of all, for those of you who know him, Bobby's
forgot more about credit than pretty much everybody in this room will ever know put together. He's going to be speaking, by the way. I didn't put out the official Twitter reminder because there's this annoying problem on Twitter. You only can have one reminder out at a time. So we're actually having, for those of you who don't know it, but by the way, I did put out a tweet that Bobby J is going to be speaking in our space. I believe it's Tuesday at 4:30 with Marty Fridson, who is sort of like the doyen of credit. So the two of them are going to be in conversation talking about credit and why should dumb equity guys like yours truly be worried about credit. I think I was not aware, Bobby J, of what you just said. I was just looking at these stocks saying, you know what? They're all high valuations, high multiple. They're all going to blow up because yields are going up. I hadn't even looked at the balance sheets of these things. One question I do want to ask you, Bobby J, when they look at the credit ratings of these things, how the way the rating agencies do their ratings, say you have a company which has $1 billion in debt and it's got a market cap of $1 billion. And then the equity goes nuts and the equity is worth $10 billion. And the fundamentals of the company haven't changed. The stated, debt to equity is the same. The losses are still the same. But now the equity, the capitalization, Amy just stated, I want Bobby J to answer this. The equity piece is worth a lot more now. So it's like Tesla. This is what Tesla did. By blowing up the freaking equity value, everyone's saying, well, look, they can raise money now, so it's a better credit risk. So when the rating agencies do these things, how does the market value of the equity affect the credit rating, Bobby?
Yeah, it really doesn't have a big impact on the credit rating. I mean, it kind of lowers the firm's cost of capital, which we know that's kind of an iffy measure anyway.
Sure.
But I would say that on the way down, ever since the financial crisis, the rating agencies have put alarms and scans to track declining stock prices more as a forward indicator of a credit problem, but it does not impact because they're looking at cash flow coverage ratios and the ability to refi.
Yeah. So I thought that was the case, but I just wanted to ask the question because I was trying to be as nice as possible to these bullshit companies like Tesla and AMC, maybe wondering that because the equity piece goes way up in value, that maybe that would help them. But you're telling me it's not the case. And before we go back to Amy and then be followed by KFAB, I just want to remind everyone, I started to mention, so Bobby J is going to be with Marty Fridson in conversation all about credit. For those of us that need credit education 101 for dummies, strongly advise you to do it. That's Thursday at 4:30. The other one we're having is Monday, and I'm going to retweet this out. So, hey, but just to mark it down, the Eric Nuttall presentations, actually he just messaged me about an hour ago, is moved up to 3:00. He's got a personal matter. So it's going to start at 3 p.m. Eastern time. For those of you who don't know him, Eric Nuttall is the preeminent Canadian energy investor from 9 Point out of Toronto. Does great work, a really good guy, is generous in sharing his information. I urge all of you, actually, he did a webinar about a week ago. I think it's up on their website. It's not in. So if you want to, well, no, actually, don't throw it up in the nest because I want the charity thing to stay up here. If you follow Eric Nuttall, Nuttall, Eric Nuttall. For those of you who don't know him, he does great work. He is incredibly generous with his stuff. You could Google him. He's in the Financial Post all the time. This is Canadian Wall Street Journal, talking about why he likes what he likes. He just recently did a webinar with Mike Rothman, who's my favorite energy analyst, interviewing Mike, talking about the outlook for the crude price itself. That is available for free if you go to their website. And so what we're going to do on Monday is I think we're going to talk more about individual stock ideas. So Eric Nuttall, for my money, I mean, there's some other people around the place. Sohaib is part of the Canadian oil mafia. There are tons of great guys. He knows energy, oil gods in the room, Shabam, Marcellus, Energy Burrito, Alberto Garbage, et cetera, Alberta Garbage, et cetera, et cetera. So if you want to know why you really should look at Canadian energy, he's your guy, and he's going to be on at 3:00 on Monday. And again, anything and everything you want to know about credit for dummies, Bobby J and Marty Fridson on Tuesday. I just listen to myself bullshit you people. I can't believe the quality of the speakers we have in these rooms. It's just phenomenal. That's why I keep saying The quality of these rooms is unsurpassed, and why, again, I implore all of you to please give generously to World Central Kitchens. I think we've raised $2,000 now in the last hour. Bobby J, you wanted to say something?
Yeah. The other thing is, I urge everybody to Google Marty Fritson. If you don't know who he is, you should. And one book you should have on your desk is Financial Statement Analysis by Marty. It's the Bible.
Thank you for that, Bobby. So we're going to, Amy, do you want to add something, and then we'll follow with KFAB?
I did. I wanted for Bob. It's what I found interesting is me and a couple other people who watch AMC when they just had that run to 34 and it increased their market cap by I think $8 billion. We were looking at the bonds, and the bonds barely ticked up, like barely moved, even adding 8 billion. And I think it's because they don't have it, they can't raise equity from, so these increases, he doesn't have any ability, he doesn't have any authorized shares to raise capital, so the bonds are just steady falling. So that's something to pay attention to with AMC.
Thank you for that.
They're trading for.
Thank you for that. KFAB, what's up?
Yeah, George, just again, I think if this whole markets thing doesn't work out for you, you got a future to replace Jerry Lewis. So you're doing a great job. But Bob, two quickies on the credit side. With what went on last week in France, anything that jumped out at you relative to European credit? And then I know you've been a hawk on, or watching it like a hawk in U.S. kind of consumer ABS related stuff. Any update there?
Yeah, no, I think it's early yet. It's going to work its way through the banking system. European banks, particularly Italian banks, have not gotten back on their feet after the financial crisis and then after COVID. I think non-performers in Italy will be the first to go up from the 4% area, heading back up to the 10% area. And European credit is going to go through a very rough patch.
Okay, you didn't say anything specifically last week with Macron going into the runoff coming up this week. That type of thing.
No. I think, it's more of what's going to happen to European growth, and also the migration problems are going to be expensive.
So KFAB, I mean, I'm really looking forward to hearing Marty and Bobby talk on Tuesday. That's going to be a real treat for all of us. By the way, when you mention Europe, one thing I do want to ask, and Albert, are you still there, Albert? I want to get Albert back up here for a second here. So one thing you mentioned Europe, Albert, if you will, please come on up. You mentioned Europe, and one of the things I don't really have an opinion. I'm watching. We all know predicting elections is problematic, but does anybody on stage have an opinion, an informed opinion, about the possibility that Le Pen could win the election, the French presidential election? Shrub for the win. So Shrub. I'm not asking who you want to win. I'm asking you, in Trump-like fashion, is there a chance that Le Pen is going to win?
I don't think there's a chance, but let me put it this way, because I've sent out a few bearish tweets about the euro and the European economy. But here's the important thing. The important thing is not that whether Le Pen wins now or not. It's the fact that close to 1 in 2 French people are supporting an extreme left or right-wing party that has affiliation and affection for Putin. Now, this is the most important thing. And this is scary, George. Because
Shrub, let me interrupt for a second, okay? Because you're a world traveler, or most of the people in this room are in North America. Could you just maybe give us a stream of consciousness, sort of like, attitude, just because for most people in this room, we're like, wait a second, how could they have affiliation for Putin? Could you please explain, like, what is it that someone who's sitting in Canada or America wouldn't appreciate about the European attitude towards Putin? Because for most of us in this room, hearing you talk and say that, it's shocking. Can you please put some color behind that?
Look, the problem with France is, and bear in mind, I'm speaking I'm talking from France right now. So the problem is, I've asked my accountant and my secretary about this specific point. And one of them admitted that she's voting for Le Pen, and the other one told me that her parents are voting for Le Pen. They don't really care about Putin at this point. They care about immigration, and in their mind, they hate Macron more than they hate Le Pen. And I've had this theory for a while, and this is like complete speculation, that the lockdowns and COVID has just made everyone resentful of the current government, whatever that government may be. So they will always look at the grass is greener on the other side. So they blame Macron for locking them down for 2 years and restricting their freedoms and putting vaccine passports. So they're willing to vote for someone who's actually supporting someone who's doing a genocide, which is insane. But look, I've kind of lost trust in Europe right now. I am very pro-European, just to be clear. And I have joked that Europe has improved since World War II, because in World War II, 100% of the French were under the Nazis, whereas now it's only 1 in 2 who support the fascist regime instead of 100%. And back in World War II, it was the Germans doing the killing, and now it's the Germans financing the Russians to do the killing. And as funny as it sounds, it's the reality. I mean, it's extremely sad. So how can you invest? And going back to the investment implications, I don't have a single euro in my name. Like I live in Europe. We're talking about a union of 500 million people, and I have 0 euro exposure. I'm all in USD, Canadian, Australian, and Nokis. So if you want to get an investment recommendation out of my rant about the European politics, is that it's a very weak union. They're an election away from a disaster. That's the important takeaway for me. So you don't really, I think you kind of want to stay invested in the US and Canada, Australia from that perspective.
So Shrub, coming back to one of my many rants in this room, the whole, triple demerit scenario. I'm very convicted. I strongly believe, I could be wrong, but it's high conviction view for me that oil prices are going up. It's a high conviction for me that rates are going up. The dollar, to the extent that it's not Europe, and Europe is totally screwed up by what's going on with the Ukraine and Russia and the energy situation. I could easily, the euro is very undervalued, but I can see it like going down a lot more because of what's happening geopolitically. So you said you don't have any money in euros. I mean, I put a gun to your head, euro upward. And again, I'm not going to hold you to it. I'm just trying to get your idea of conviction. Gun to head, okay, so you have no money in euros. I get it. But if I said to you, give me your bet, like how bearish are you in the euro? Do you think it's just not going to go up, or do you think it can really fall out of bed? Just go a little bit more on the euro, because it's undervalued. Sure. It's undervalued, but it's
undervalued. That's for sure. But let me put it this way. So the reason why I'm looking, the currencies are always a relative trade, right? So the Australian currency is 6 times covered by resources and energy. So they cover their own needs by 6 times. Even the US has is self-sufficient energy. Canada is covered multiple times as well. Europe is covering its energy needs 20-30%, and the rest comes from outside. So, my bearish euro thesis is actually a bullish energy thesis. So, I'm going to take it a step further. I'm not only bearish euro, I'm long European real estate backed by fixed rate mortgage. And my assets are invested in energy and commodities in real currencies. So am I bearish that I think it's going to go to 50 cents? Not really, but I'm bearish enough that I'm willing to put my assets in.
No, I get it. I get it. So let me put it this way. I'm not trying to hold you to it. Okay, I'm just trying to calibrate your bearishness.
I think the parity. I think we could see parity.
Okay, that was the question I was going to ask. So you think parity's not out of the question?
Yeah, and look, I think Macron is probably going to win. I think he's going to win with an 80% chance, and you probably will see a bounce there. I'm not going to get I'm not going to get sidetracked and try and chase it.
Yeah. It's funny you say it. It's like when people say, "Gee, Kathy Wood ARC's oversold. Do you want to buy something? I don't give a
It's the
shit.
same thing. It's the same
I
thing,
don't
George.
give a shit.
Yeah.
It's a piece of shit. It's not.
Yeah.
It's a sinker, not a floater. Excuse my vulgarity.
And also, just to add one quick point on
Yep.
this. So the ECB met this week. The ECB is the most irresponsible central bank probably out there, like the BOJ. They have an inflation problem that's a disaster, and they're still buying bonds, and we have negative 50 bips interest rate. So if you guys think the Fed are crazy, the ECB is like whole different level.
That's awesome. KFAB, did you have a comment you wanted to make? Otherwise, I'm going to go to Arthur. KFAB?
Yeah, no, just real quick on the concept of, and I've been saying this for weeks now. Everyone's been talking about how strong the dollar's been, and I know Three Aces has been focused on it, and I've been arguing the U.S. dollar has not been strong as much as it's been the euro and the yen have been weak. And if you look at things like the South African rand, the Brazilian real, I mean, there's plenty of commodity currencies that have been doing, normally in a risk-off environment, you'd get these kinds of currencies getting pummeled against the US dollar. If it was a true risk-off liquidity issue, flight to quality, that kind of thing. So this has just been really severe euro and yen weakness that's made the dollar, because a lot of people just look at Dixie and they translate that to USD. When the vast majority of that is euro and yen.
It's an excellent point, and everyone needs to pay attention to that. I mean, KFAB, that's fabulous. So hold on. Before we go to Arthur, Albert's back. So Albert, do you want to talk about Macron or anything else we've been talking about in the last few minutes?
Yeah, I just wanted to give my my French perspective on that, and on the euro or Europe. So first on the election, I think it's. I would say it's 99.9% chance that Macron wins, and I think he will win. It's going to be like 55-45 or more for Macron. I think there's not a chance that Le Pen wins, and I wouldn't be scared by any of that probability. And on the euro and Europe, I do agree. I do agree that Europe is pretty screwed, unless or until there is a regime change in Russia. But let's face it. I mean, who is going to invest? Even let's say France, Spain, Portugal. As far away as Russia is possible, or the UK, maybe they're fine. But who's going to invest in the Czech Republic or in Slovakia or in Hungary or in Poland or and all these countries which are bordering Russia are have been big drivers of economic growth in Europe. So and now you've got this this huge Damocles sword on top of all these countries, and I think Europe is going to be screwed for for a very, very long time. So when you look at the the premium of US equities versus Europe, and Europe is so cheap and so on, but I think there's going to be Europe is going to be at a permanent discount to the US for a long time. And in fact, now you can understand why Europe was so cheap, is that the market is always right. And
yes, Albert, let me ask you a question, because you and I are both concerned about the market, and you and I also like spread trades and pairs trades. So just listen to you talk. I mean, you talk about how you like Argentina and Brazil. How about just like going long Latin America versus short Europe on a spread basis?
Yeah. I mean, I think I quite like long Latin America and short Asia, actually. Asia ex Japan.
Wait, so hold on. No, wait. Which is bigger garbage, Asia ex Japan or Europe? So if I said to you, you could be long Asia versus Europe or Europe versus Asia, which one do you think is the better trade?
I don't know. It's probably all shit. I mean, I'll be long. I'll be long Latin America. I've got to trade long Latin America versus the EEM ETF, the emerging market ETF, which is a lot of Chinese stocks. But I think there's going to be. I mean, Asia's got its own geopolitical risk with China and Taiwan.
Right.
Maybe that's going to happen sometime.
So I'm teasing KFAB. So KFAB wants to sharpen up his factor exposure. So basically what we want to be doing is being long Latin America commodity-based, resource-based stocks versus short a bunch of Asian-based technology stocks. Would that be even a
Yeah,
better expression?
That's the same thing. Yeah.
Yeah. KFAB, you like that one, KFAB?
Yeah, I'd probably throw in a little bit of convex currency hedging in some of those EMs because they've run quite a bit here acutely, and if we do get this kind of risk off flight to quality at some point, i.e., the U.S. market finally spills and dips quite a bit, and there's true liquidation going on globally, then I'd want a little bit of currency protection there.
But KFAB, you know something? Normally I would agree with you, but listening to Albert talk and based on something I read the other day, I think it was from GavCal or whatever, it points out despite a risk-off environment, some EM currencies have been appreciating because they're better current.
Yeah, that's what I'm saying. If that reverses, I'd want to hedge it. I wouldn't go crazy, but I'd want some.
I get it. Okay, that's helpful. All right, we're gonna go to Arthur and then Scott D. Arthur, what's up? Arthur? I don't know where Arthur is. All right, Scott. Arthur, unmute yourself if you're listening. All right, Scott D, please unmute yourself if you're listening. Scott D. Oh, Arthur, you're there. Go for it, Arthur.
Okay, thanks, George. Real quick, I wanted to ask Bobby J if he tracks or he's following the MBB or the HYG, both of which are at lows that we haven't seen since 2009, and if he has any comments about those two vehicles.
Yeah, I think the purest way to follow high yield spreads is go to the St. Louis Fed and look at the ICE Bank of America Merrill Lynch Index, B of A, ML, option adjusted spread. Those two that you mentioned also have a treasury component, so they don't have a pure spread. It's another one of those CNBC, crowd pleasers that they threw out. And if you think you're following high yield by watching HYG, you're not, because you don't have the spread action there. So go to that, and we'll be talking about that Tuesday.
Yeah, Bobby J, apropos of that question, the spirit of that question, for the average home gamer, as Jim Cramer would call them, what liquid traded thing can people look at to give them a better idea of credit? Like, for instance, maybe it's not HYG because of the yield components. So maybe you look at the spread between HYG and TLT, or maybe there's some other ETF. Like, for someone who's doing this at home who doesn't have your visibility and your experience, like, how do they get a handle? And then even if you were to isolate the duration exposure, you and I have talked about this. It may be a problem where energy spreads are coming in because energy is going up, but meanwhile,
exactly,
all the tech and consumer crap is blowing up. So then you got to get down to it on a sector basis, or is it just so nuanced and complicated that, as the saying goes, don't try this at home? What would your advice be?
I would say go to the St. Louis Fed. It's free. You can get great bond information there. Easy graphs. You can make a dashboard. Just sign up an account. There's no really shortcut around this, George, in terms of getting that spread information. Why start doing calculations when you can go straight to that indicator?
So Bobby, is that the FRED, the FRED?
Yes, FRE FRED, and look at just within that, do a search for ICE index. Maybe we'll be posting that. I could actually post that on this room.
Yeah, but Bobby J, what is the ICE index? What is that?
It's just a I don't know exactly what the acronym stands for, but it's a BA2 yield spread.
All right. Okay. All right.
It's the best thing out there. It's pure. It's pure.
KFAB. What's up?
Yeah. Just quick. There's two ETFs for dummies. So they're not terribly liquid, but on a daily basis, just for people if they want to kind of look at stuff. HYGH. So it's basically interest rate hedged for the HYG. Again, all Pop's points are very pertinent, but again, for a simple thing. And then LQD also has one, LQDH for investment grade corporates.
So each of those strip out the duration component. Is that what you're saying?
Yeah, basically they're interest rate hedged. The other thing for a mortgage perspective, one that I've looked at is if you look at some of the preferred stock from mortgage REITs like Annaly, if they're trading pretty close to par around 25, 24, usually you're not getting any kind of major mortgage market disruption. When those things start to get hit, that's when you start to see things really start and go haywire. Yeah, they break down into the 23, 22.
Yeah, so Keith, that's fabulous, absolutely fabulous. By the way, I'm not going to speak for anybody. I'm just going to speak for myself. But it's funny. I'm looking at this thing. I promised myself I started this room today. It was only going to go for 2 hours. We're at 2 hours and 50 minutes, and my partner Susan just walked in. He's like, "When are you gonna get off the phone?" I'm like, "No, I'm having a good time." Like, what else am I gonna do? You guys are great, and it's like we've got such a good thing going with so many smart people, different perspectives. We just learn from each other. I just marvel at this room. It's just extraordinary. Okay, so hold on. We got Robert had a question. I think Robert.
No, sorry. I just wanted to add a quick comment. I also wanted to mention the HYGH. But one thing you have to keep in mind is it's fixed income, so you can't look at the price. You have to look at the total return because it pays a coupon. That's also a common mistake that people like to make.
Exactly. Yeah.
Yeah, that's fair. All right, so Bobby J, really, like most things in life, there's no shortcut. You're saying we have to go look at the.
Yeah, you really do. You want to see the spread. And, we're in the 400, 500 area, and we're probably heading to 900. And Marty's also going to talk about his correlation model between the VIX and double B spreads.
Hi, Bobby J. This is George. I'm a first-time caller. So I want you to explain, please, if spreads go from 500 to 900, what will that do for my Vanguard index fund? Thank you very much, Bobby.
You probably should not be investing. George, but I also want to say something about you, what you've done here. You've taken a lot of people, including myself, because I remember being in rooms years ago in meetings saying George Noble is thinking this at the moment when I was at BEA. And you've taken a lot of people from certain beginner knowledge of investing to intermediate. And the one thing I like about this room is we're heading to advanced intermediate over the next year. And as we do that, let's give people more and more tools to be able to round out their toolbox.
Thank you for those kind words, Bobby. I appreciate it. And again, I do it because I want to help people. It is fun, but I learned a lot from you guys. I mean, I've learned so much from you, Bobby, about credit in the last, 6-9 months. We've gotten renewed our friendship. So, and all the other people in here. I mean, Shrubs, I consider a good friend. I mean, Bob's in here, KFab. I mean, so many great people. Michael K, who I'd followed for years but never knew him. I mean, I see Abe. I'm just looking down the list here. These people I never knew existed before. It's just so wonderful. I'm kind of thinking we're going to end the room, except. I would like if Schmuckatelli is around. I don't know if he's hearing me, but I'm going to do a room on the Ukraine and the war one of these days. But if Schmuckatelli, he's in the fourth row, is listening, if he could come up and just give us sort of military exploits for dummies, I'm inviting him to speak. So Schmuck, you gotta raise your hand or accept the invitation. I think we need an update for you. What's going on in the Ukrainian theater? And I just want to for those of you who haven't heard him talk, no, his real name is not Schmuckatelli. He has the best name in Twitter. Period. I know his real name. But I'm not going to tell you who he is. He has the best name, and also his partner in crime, L'Enfant. I don't think he's here, but if he is, he should raise his hand. Schmuckatelli is a vet. I thank him for his service to the country, and he's still very switched on in terms of what's going on. He doesn't have any inside information, but he's been in the locker room long enough, so to speak, just like some of us. Bobby J's been in the credit locker room long enough. I've been in the equity locker room long enough. Well, I don't pretend to know what's going on in the Ukraine, and people ask me, I'm like, I don't know. That's beyond my pay grade. So I instead defer to people who, they're not going to know necessarily, but they have a better appreciation and perspective. So L'Enfant and Schmuckatelli are friends of this room. They provide invaluable insights as to what was going to happen. They called it, actually. This is before the invasion took place. And I remember he's like, nope, they're going to do something. Like, why are you saying that? He goes, look, you don't have to put 150,000 people up on the board or to do something if you want us to just scare people. So he's been right. And more importantly, he's always got a very thoughtful, balanced perspective on things. So Schmuckatelli, without further ado, welcome, my friend. And I think the people in the room will be very grateful to hear your sort of updated, updated insights. Thank you, Schmuckatelli.
George, you like a couple other people are like my boss on Twitter. My boss asked me something the other day that I didn't want to do. He said, will you do it for me? I said, my answer to you is always yes. Just assume that. Because he's a great boss and I have a great position and I want to keep it that way. And, but I'm going to let you know that I have to leave in 4 minutes because Shubham is giving a laydown that I am very anxious. I've got my notepad out and I invite all of you to go over to White Tundra and to listen in on Shubham's space. You will learn a ton. He is the smartest.
By the way, let me interrupt. I second the motion. For those of you who don't know him, it's at White Tundra, Shubham. So good. That's a hard stop. So you've got 2 minutes, Schmuck.
Okay. I'm gonna keep it pertinent to the room, and I'm not trying to be mercenary, but this is not ending. So whatever your strategy is because of Russia, Ukraine, it's not going to end next week. It's probably not going to end next month. I heard someone say it may not end this year, and I thought to myself, that's actually reasonable to consider. There are humanitarian atrocities occurring over there. Even if it did end tomorrow, which it will not, these sanctions are going to become multiplied and they are not going away. Abe has spoken eloquently on what's going on over there. He's been pushing steel for longer than many have been, 30 years plus. And I've got a great deal of respect for Abe. So what my general thesis, keeping it to the investment side of the house, is that it's going to get worse. Putin has already escalating after they sunk the Moskva. The Moskva was a major warship, was a flagship of the Black Sea Fleet. I'm a Navy guy. That was a major event, 500 sailors. I don't see mothers demonstrating. This is the iron grip that Putin has on Russia. Okay. The cars are still in the parking lot. That means the sailors drove up to the pier, boarded the ship. Those cars are still there. If you want to know the number of casualties on the Moskva, go ahead and look at commercially available overhead satellite imagery of the pier where the Moskva set sail. It is a major, major victory for Ukraine. But in the long run, I think Putin is now going to use this to double down. So it's going to get worse before it gets better. The sanctions are going to continue and multiply, and they're going to last for years, if not decades. And I guess that would be the short 2-minute elevator pitch I'd have for you right now, George.
All right, so Schmuckatelli, you and Lawfont, I think we back the channel message. You guys, I need you to do a war room sometime in the next week or two. I think it'd be really, really helpful. Would you be up for that?
Yes, sir. Of course I would.
Awesome. All right, listen, that's going to be it. We got a hard stop. Last appeal. Please, 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 if you got value from this room, please give generously to World Central Kitchen. These people need our help. I think these rooms are value for money or without peer. And so if you got value, please, I think we've raised a little bit of money here today, $200,000 or something like that. Again, I feel like someone, like you said, KFAB, like I'm channeling my inner Jerry Lewis, but no personal benefit here. This is the best stuff you're going to find on the internet, period. Please give generously to World Central Kitchens. Please come back Monday with the best Canadian oil analyst in the world, Eric Nuttall. And then Thursday, I don't know if Bobby is the best in the world. I don't know the credit space that well, but two of the smartest credit guys I know, Bobby J and Marty Fritzen. We're all going to learn a lot. We're all learning together. I learn a lot from you. I thank all you. Again, please give generously to World Central Kitchen. Thanks very much. And yeah, go by all means, listen to Shubham now. Take care, everybody. Bye-bye.